Questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
All right, welcome back to Bloomberg Markets. Caroline Hyde, Paul Sweeney. We are simulcasting from the Bloomberg Radio studio in Bloomberg HQ in New York City. Looking at the markets here, a little bit of green on the screen. Not going to oversell it here. The S&P up about 0.3%. NASDAQ up about 0.2%. And the Russell giving you a little bit more performance here, up about 0.5%. And that's a trend we've seen over the last 8 or 9 weeks. That is smaller cap stocks outperforming. Yields coming in. The 10-year Treasury's in 10 basis points, 3.79% on your 10-year. WTI crude oil is off 1.5%, $74.40. And Bitcoin, another good day, up 1.5%, just under $43,000 per token. And I guess one of the economic wins, if you will, that have kind of shifted over the last 6, 7, 8 weeks has been this soft landing thing is getting a little bit more airplay than maybe earlier in the year. What with the Fed signaling that it is open to a pause or a more dovish tone here. Let's check in with somebody who actually does this for a living. Betsy Stevenson, professor of public policy and economics at the Ford School at the University of Michigan, and still a Bloomberg Opinion columnist as well. So, Professor, thanks so much for joining us here. I don't know, it feels like the market may be getting a little over its skis here too much in the last 7, 8 weeks. But I guess let's just start with the basics here. Is the Fed likely to navigate a soft landing here? Is that your call?
You know, the world keeps on moving, so it's going to depend on when we're going to call it a soft landing, mission accomplished. I think a lot of people are ready to declare that right now. We got the soft landing.
Yep.
If you look at the Fed's target inflation rate over the last 6 months, the annual rates come in actually below the Fed's target rate of 2%. And we've still continued to have unemployment well below 4%. So here we are. It's the end of 2023. No one saw this coming, or I should say very few people did. You know, a year ago, we had 85% of people forecasting a recession. Those who didn't think we were going to have a recession thought we were going to have really, difficult to address inflation that was ongoing. We've got neither. We're clearly at this point of a soft landing. Now, there's a question of, does it stick? Are we able to keep inflation down over the next 6 months? Is it going to stick at the Fed's target? And are we going to be able to keep the economy humming along, over the next 6 months? I think we're going to probably want more than 1 month of having touched down with that soft landing before people really declare that it's here. But I think it is important to realize, like, we are ending the year with, by almost any definition, the soft landing has been achieved.
Professor, you mentioned the labor market. Just from my perspective, that's been an amazing source of strength and stability in this economy, the strength of the U.S. labor market. We actually saw the unemployment rate tick down last month. What do you think is really supporting this labor market in the face of a really brutal rate increase environment over the past 18 months?
Even without a brutal rate increase over the last few months, like, why has the labor market been able to be so strong? And in my lifetime, the view of economists has been that you can't really sustain unemployment below 5%. And yet we have sustained unemployment below 4% for a long time now, and we've done it in the face, as you said, of an increasingly challenging economy with rates going up, with inflation. Why is that? I think part of the answer is that it was a very, very dynamic labor market as all these challenges arose. Lots of people were switching jobs. Remember that record high quit rate?
Yep.
Quits, which have come way down, are still above where they were in 2019. So we've just had this very dynamic economy. It's brought a lot of people back into it. There's a lot of change going on. And all of that, I think, has enabled there to be some layoffs, which there have been, right? Think of the tech layoff stories of 2023. But there's been enough businesses out there hiring. There's been enough other opportunities out there that we didn't see people getting laid off and getting sucked into long durations of unemployment.
Betsy, I'm interested in the risk factors around the soft landing that you think perhaps we've already managed to achieve. I mean, I'm looking at this exact moment. We have the NASDAQ 100 at a new record high. We have a record high being hit by the Dow on an intraday basis at one moment. The market still thinks this inflationary cool down is set in stone. The Fed is going to be cutting maybe even as soon as March. But we do have the Red Sea concerns. We do have the supply chain anxiety just creeping in the background. Do you think that's any sort of a key concern to this economy right now?
Recessions are always caused by some sort of negative shock that's hard to predict. I think that's why economists and people are really lousy at predicting recessions. I remember doing interviews in 2019 where people kept asking me, is there going to be a recession in 2020? Is there going to be a recession? Well, unless you had a crystal ball and you knew that COVID was coming, you didn't have any reason to predict a recession. The recession we had in 2020 was clearly caused by the pandemic. The economy was very strong going into that pandemic recession. But a pandemic coming out of nowhere tanked our economy. We can see a bunch of problems out there on the horizon, global conflict for sure. We could see economies out there having much greater trouble than the United States is having, and those are our trade partners. So, just macroeconomic problems abroad could end up spilling over into the United States. All of these things are a concern and should be a concern. And it's why the Fed is not going to promise what they're going to do in 2024, because they've got to be data dependent. Yeah. That said, the reason people are expecting rate cuts was because the Fed told them, we anticipate rate cuts. Look at where they said the dot plot was going to be for 2024 in September, and then compare that to December, right? The central tendency, meaning the vast majority of people on the FOMC don't see rates going any higher, and they see rates coming down, right? The top end of the central tendency is 4.9%. That's a cut. The bottom end is 4.4%. That's an even bigger cut. So there's a reason the markets are pricing in these cuts, because the Fed just told them that's what we think is going to happen.
What's interesting, though, of course, is it's not always about the way people actually feel. And we were talking yesterday about this new word that was put in dictionary.com, coined, I think, by our own Bloomberg opinion columnist, Kayla Scanlon, called vibe session. And ultimately, it's about how you feel. And yes, inflation's been cooling, but people still have sticker shock. As someone who is the President's Council of Economic Advisors, as someone who is a chief economist at the US Department of Labor, as with your policy hat on now, what do you advise the administration as we go into an election year if people still, the vibes aren't great, even if the economy is good?
First, I do think that the vibes are starting to improve, right? We saw consumer confidence starting to tick up. I think that the administration needs to make their case on the facts, and they need to do it in a non-defensive way. We can all think about our personal relationships. If you bring a problem you have to a friend or to a romantic interest, and you say, look, I'm unhappy about this, and then they tell you, no, you shouldn't be because XYZ, that's not actually, that conversation's not going to go great. And the same thing's the White House got to learn a lesson from that. They can't go out and tell people, don't be unhappy. That's silly. Look at all the great things we've done. What they need to say is, we understand that you're unhappy, and we understand that this has been a challenging economy with a lot of change, a lot of upheaval. Prices have changed, jobs have changed, the things you do in your job has changed, childcare has been hard. We've been doing everything we can to try to not just get us back to normal, but to get us to a better normal. Here are some of the things we've done. We think we're on the right path. We're going to keep doing more. I think it's got to be that kind of message. I think it's got to be I really deeply hear and feel your pain, and this is how we're going to be able to, to keep moving forward. I don't hear anything on the Republican side that's saying like, well, we would do this instead or that instead, and it would be better for people. What I'm just hearing is people feeling frustrated and upset. Right. And so, that's we got to start, as you said, it's the feelings and the vibes. We got to start by acknowledging them.
Betsy, thanks so much for joining us. Really appreciate getting your time. Betsy Stevenson. She's a professor of public policy and economics at the Ford School. That would be at the University of Michigan. She is also a Bloomberg opinion columnist. Some more discussion from some more smart voices on where interest rates may be going. Bill Ackman, Pershing Square Capital Management founder and CEO, sees the Fed cutting rates as soon as the first quarter of 2024. Here he is on the David Rubenstein Show, Peer-to-Peer Conversations.
I think it's really hard to predict. I do think the economy is weakening. We're seeing, evidence of that in some of our companies. You're seeing, I have some concerns. There's been a huge subsidy in terms of low interest rates, and most companies fix their rates or their debt at very low rates, and certainly real estate investors did the same. And that works until it doesn't work. And so I think what's going to be interesting is to see what happens when people have to reprice their debt. And I think that can have sort of a cliff-like effect. And you're certainly seeing that in real estate.
Now, the markets are assuming, and the markets are not always right, but the markets are assuming that there's going to be a Fed discount cut sometime next year. And as we talk now, just about the end of November, it's not clear what the Fed will do, but some people say that the Fed, if they were to cut interest rates next year, would help the Democrats and therefore be seen as very political. On the other hand, some people say the Fed can't wait till after the election because the economy might need a stimulus. So you have a view on what the Fed's likely to do?
I think they're going to cut rates, and I think they're going to cut rates sooner than people expect, because what's happening is the real rate of interest, ultimately, which is what impacts the economy, keeps increasing as inflation declines, right? So if the Fed keeps rates in the sort of middle fives, and inflation is trending below 3%, or that's a very high real rate of interest, and I think that is having a sort of retarding effect on the economy. And then, of course, again, many businesses and certainly many individuals have the benefit of fixed rate debt. And that fixed rate debt, certainly for companies and for commercial real estate, starts to roll off. So I think there's a risk of a hard landing if the Fed doesn't start cutting rates, pretty soon. So, I think the market expects sometime middle of next year. I think it's more likely probably as early as Q1.
By its own admission, the Fed probably missed inflation initially. They said it was transitory, but they played catch up and they've increased rates considerably since that time. Do you think the Fed made a mistake in not handling inflation differently in the beginning? And how do you think they've done since they started increasing interest rates?
They certainly made a mistake. I mean, I think that the Fed generally as an institution would admit that. I think that they caught up effectively, so you give them credit for acknowledging the mistake and being pretty aggressive. And then I think, you want to make sure that they're, Chairman Powell's desire not to have a legacy of causing or contributing to long-term inflation doesn't, cause them to make the opposite mistake. I mean, keep rates too high for too long. And I think the market expectation is, it's called middle of next year, July, something like this, for the beginnings of easing. I think the economy will likely demand an earlier move. And I don't think of the Fed as or at least this Fed, as a particularly political institution. I think they're really trying to do the right thing.
All right, that was Bill Ackman, the Pershing Square Capital Management founder and CEO, sitting down with David Rubenstein at the David Rubenstein Show, peer-to-peer conversations. He's calling for, Mr. Ackman, rate cuts maybe a little bit earlier than some other folks think about.
Which actually is, I'm hearing the growing narrative of the reverse. The market sort of really getting excited about the March date, the idea that we could see 150 basis points over the course of the year. But there seems to be some more market analysis saying, look, it's going to be July. Ultimately, this inflationary pressure is still going to be somewhat there. The labor market is still going to be so good. Yes, we'll cut, but maybe not quite as soon as the market is currently envisaging.
And going to the labor market, what is labor hoarding? I mean, I have never seen or heard of a company hoarding employees, given the cost of that. But apparently, economists, they keep saying that's a thing out there, because I keep saying, why is this labor market so robust? And we actually saw the unemployment rate tick down a little bit last month. I don't know.
They don't want to train people. Or retrain them. And I wonder where, ultimately, that's where AI eventually comes in. We're getting more and more technology that's going to be able to, particularly in the industrial area, where really a lot of the craftsmanship and the knowledge is within a few heads. Can they train that? Can they ultimately make it a lot easier, a lot cleaner to train up new hires? Does that make it a more dynamic labor market all over again, where we don't hoard, we're a little bit more fluid in and out?
Yeah, it's just amazing. But again, 3.7% unemployment, that feels like full employment to me. Coming up, we're going to take a look at Wall Street, the year that was, and maybe some of the trends for 2024. Sally Bakewell from Bloomberg News in London is going to join us with that story, because it is bonus payment time coming up in just a few weeks on Wall Street. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Bloomberg Markets, TV and radio. We join forces at this time of year, December the 27th, one Caroline Hyde and Paul Sweeney in the house for you. And talking about sort of a little bit of the uptick that we've seen in some unloved areas of the market of late. We're seeing the Russell 2000 doing relatively well and into the end of the year. The KBW Bank Index is one to sort of also keep an eye on. I mean, there's not much happening across the board on the day. We're up 0.3%. But maybe over the course of the last month or so, the KBW is up some 15%. But this has been a year where basically the biggest got bigger. And there's a great piece on the Terminal talking about how it's a tough year for almost every bank not named JP Morgan. Let's go out to one Sally Bakewell, who can talk us about really what it is like in the banking industry at the moment. Ultimately, more than a decade after regulators have said that they're going to tame this too big to fail mantra, it's still alive and well, it feels.
Yes, and I think if we reflect on the year we've just had, a really big important factor obviously was interest rates. We had 4 interest rate hikes in 2023, and that puts the pressure on banks' deposit costs. It eroded the value of some of their supposedly safe investments, and this became overwhelming for some lenders and contributed to the collapse of several smaller lenders earlier this year. But now the market is pricing in a sort of an aggressive path of cuts in 2024 that eases that competitive pressure on banks, fighting to keep depositors from fleeing to higher yielding assets, and that will also help regional lenders who are grappling with unrealized losses. And for this reason, we've seen a bit of that bank stock rally you mentioned this month. But that also raises the bigger question that you also raise is, you know, what does the banking landscape even look like in 2024 after this regional banking turmoil, after JP Morgan rescued First Republic, making JP Morgan even bigger? Signature Bank, Silvergate, and Silicon Valley Bank all collapsed. PacWest, it merged with a smaller rival. So do we have a landscape of further consolidation next year? Do regulators even want that amid too big to fail concerns? Well, in May, we heard Treasury Secretary Janet Yellen say that the environment that we're in, where there's pressure on earnings, that may lead to more concentration in the sector, and regulators will likely be open to those mergers. So 2024 could hold a little bit more consolidation in the sector.
Sally, there's a great chart in the Bloomberg News reporting here. It says JP Morgan is worth more than Bank of America and Citi combined. I had no idea they were that much bigger than everybody else. Is there a feeling in Washington or just within the world of banking that JP Morgan's just gotten too darn big?
Yeah, I think that was definitely a concern surrounding its purchase of First Republic, and that that excellent story by Hannah Levitt and Max Abelson, opens with that great anecdote that they had the highest bid when it came to rescuing First Republic, and in fact its bid was 4 times larger than the 3 other bidders, which were PNC, Citizens, and Fifth Third, not small banks at all in their own right. And I think basically since JP Morgan bought Bear Stearns and Washington Mutual in the financial crisis, it's been able to add a mountain of assets that are essentially equal to Wells Fargo, which itself is the 4th largest lender. So yes, I think there is concern about this too big to fail kind of slogan that has been with us since the previous financial crisis. And indeed, it looks like one consequence of the recent regional banking turmoil is the biggest banks dug a deeper moat around themselves.
One area of concern looking into 2024, which keeps coming up, is sort of the real estate area and holdings of, in particular, commercial real estate by smaller, local banks rather than the big lenders. How much is that a reality? How much is that something that people are keeping an eye on as to what could yet still trigger further concerns for a KBW Bank Index, for example?
Yeah, I think it's a really big concern for the regional lenders, not so much for the bigger banks, as you mentioned, which really don't have significant exposure, or at least any exposure is sort of mitigated by the diversity of their businesses elsewhere. But for regional lenders, they have tended to be more exposed to commercial real estate, which is the area where there is significantly more pressure. And, I think the statistic for regional bank exposure, it could be around sort of 18% to real estate, and obviously commercial real estate is within that. And this has already bubbled up as a problem for a lot of smaller lenders, and they've mentioned it in earnings calls, and they've made write-offs to some of these assets. So we could expect to see potentially more of that in 2024.
And Sally, one of the things I learned, at least during some of this regional bank troubles at the beginning of the year, there's 4,000 regional and community banks in the United States. That's unusual. Not a many other developed countries have it structured that way. Is there a belief that maybe there should be some consolidation within those just to compete against some of the bigger banks?
I think that's probably exactly what will ultimately happen. Do we need 4,000 banks when banks like JP Morgan have been expanding in a lot of regions? And we have seen since it bought, First Republic, it's also made inroads into some of the clientele and business areas that Silicon Valley Bank was very prominent in. And I think the banking industry has got some good templates to work off this year with PacWest, which indeed combined with a smaller rival. And that was a deal that regulators, it seems like they encouraged, they liked, they certainly put no hurdles in its way. And again, thinking about what Janet Yellen said, they'd rather have banks do this than succumb to the sort of pressures that the failed banks succumbed to earlier this year, which would, of course, cost them money because they need to use the FDIC insurance fund to protect depositors in that case.
All right, the rich get richer in banking. That's certainly the case. Sally Bakewell, thank you so much for joining Sally Bakewell, Bloomberg News. Let's stay on the discussion of financial services with a little fintech here. Motive Partners founder Blake Masters says the next 10 years of fintech innovation will be driven by artificial intelligence. Here's some of the conversation on Bloomberg Wealth with David Rubenstein.
The last 10 years of financial services has seen an extraordinary change. The advent of digital banking, mobile banking, and all of the technology-enabled services that we have now come to consider to be table stakes. The next 10 years is going to take that technology impact and expand it exponentially. There are enablers to that, but the primary driver is going to be related to the deployment of artificial intelligence. It's very interesting, if you look back in the beginning of the internet era, 2000, 2001, of course, there was a bubble, there was all sorts of excessive exuberance. And we know that there was a there, because what came after that delivered real change and real value. But people were very unsure back in 2000, 2001, what did the internet really mean? Would anyone ever really trust the World Wide Web as a place to do business, let alone financial services business? As we look forward at the potential for artificial intelligence as we see it today, I don't think any of us is in any doubt about the profound threat and opportunity that represents. it is intuitively obvious, and now, in a very real way, we as individuals get to interact with artificial intelligence through things like ChatGPT, which has taken the world by storm, and can see with our own eyes and feel and become enamored with the way in which these ingenious programs are able to interact with us. And I think that will really profoundly change not just the financial services landscape, but pretty much everything we do.
So I have the view that sometimes the easiest way to sell your company to an investor is to put AI behind it. In other words, it's company AI. And you add AI, all of a sudden people think it's been great now. Not everything is AI, right? But do you think people are getting so enamored with the AI concept that people are going to put money into things that really aren't AI or not very good AI?
It's possible. I mean, we certainly experienced that same thing with blockchain a few years ago. You know, you plugged a blockchain into a press release and the impact was 10x. So I think it's possible. I think the other risk with AI is that it grows too quickly, too fast, is unregulated, and all of the inherent biases and abuses of the technology are unchecked. And that would be a devastating loss.
All right, that was Blythe Masters, Motive Partners founder, and of course, J.P. Morgan alum, longtime banker.
CDS.
Yeah.
CDS creator.
Exactly right. What a career she's had. Anyway, sitting down with David Rubenstein talking about fintech. And I don't know about you, but during the pandemic, I think I upped my fintech game pretty big. I got apps all over the place now, depositing checks, we're just taking pictures. It's the new me.
I just thought you were going to say, yeah, and I got a crypto app where I'm like buying and selling on the daily. Are you getting confetti whenever you put in a trade?
I'm pretty psyched just depositing checks by taking a picture, but I still walk around with a big wad of cash because you never know.
Oh, I'm
but the
terrible.
Kids don't do that.
Yeah, I'm terrible. I'm in a completely cashless society, which
yes,
is not great when you want to buy a light-up balloon for your daughter on the street after seeing the Rockettes last night, I can tell you.
Oh,
Venmo came to my rescue. It was amazing.
The Rockettes lived up to it, right?
I've literally never been to something that electrified so much in quite a while. My daughter was thrilled. I was even more thrilled.
That's great stuff. That's a great New York tradition, the Rockettes. S&P 500 up 0.1%. This is Bloomberg.
The annual prize money pool in LPGA tournaments has grown 50% since 2019. In 2023, it topped $100 million. But the prize fund still lags far behind what men compete for on the PGA Tour. The inequality hits hardest at the lower end of the money list.
Clearly, we want the top players to continue to make a great living playing. These are the very best in the world. But we also then dig in and say, okay, what's the 50th best player in the world making, and what did she make last year? I've asked Kathy to run numbers many times to say, okay, tell me where we are exactly during the middle of the season, at the end of the season.
That 100th player, our goal would be to obviously have that player make considerable amount of prize winnings, and we're going to work really hard to do that. Having said that, we do need to continue to focus on ways to provide opportunities so that 100th best player can cover those costs that it takes for them to be out here on the golf course. That's hiring a caddy, that's travel, that's strength coaches. We're helping to provide stipends for health insurance or create a tour-wide health insurance program. Ability to create more discounts for travel, you know, for hotel and car and all those things that really cost them a lot.
To meet these objectives, LPGA leadership collaborates creatively with sponsors.
We've worked with some of our corporate partners to say, help us solve a problem. You know, help us create a fund that will allow our players to get to the first tee ready to reach peak performance.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to
be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Markets on Bloomberg Television and Bloomberg Radio. The closing bells ringing on Wall Street in just a couple of hours' time. We do have 3 more sessions left in the year, including today. Well, if we were within a whisper of a record for the S&P 500 yesterday, we are within a hair's breadth today, about 15 points away from a closing record. Volume, though, pretty anemic. We're at about 40% of the 20-day moving average. Shonali Basak is with me, and I do want to point out that there are pockets of activity in this market today, Shonali, albeit a quiet market. Fixed income, for example, seeing some activity. We're also seeing some activity in commodities, and we have seen about 40-plus stocks hit all-time highs, so that bodes well for the last couple of sessions of the year.
A little bit of momentum. You are saying the Santa Claus rally is still going, but cooling down, not the same type of velocity we saw just a day ago. But to your point, that bid in the bond market is quite impressive, and seeing where yields end the week, both on the 2-year and the 10-year, let's see how much of a bid there is when you think about duration as we think about fixed income here.
And of course, we had more auctions today, so there was actually plenty of activity around that sphere. We're going to be talking to somebody in just a moment who can tell us a little bit more, but the auction saw plenty of demand, just as yesterday's did. So the bond market hasn't fully had its say for the year, even if the equity market looks like it might have.
It's interesting, Vanna. You're watching the S&P 500 really struggling to hold on to its gains here. Now essentially flat on the day, but you are still seeing a little bit of a bid in other indices like the Russell 2000, still up 0.2% here. The SOX, where just yesterday every single stock in the SOX semiconductor index was in the green. Now you are seeing declines in that index on the day. Talk about that rally losing some steam. The NASDAQ also struggling to hold on to some gains. There's still a little bit of green on the NASDAQ 100 on the day.
So let's take a look at where we are yield-wise now after that 5-year sale stopped through, pricing at a lower yield than when issued. We have the 2-year yield at 4.2334%. Look at that, the 10-year yield at 3.7926. Investors are locking in those yields, I'll tell you, at the end of the year. We are seeing a little bit of steam coming out of oil markets. So WTI priced at 74.23, now down 1.8% or so. Gold, it's up 14% this year. We're off our highs for gold as well. Spot gold price today at $2,077.26 an ounce. That's about $30, or actually a little bit more than that, away from an all-time record, but it does look to be headed that way as well. Well, let's talk a little bit more about these fixed income markets and bring in James Camp. He's Eagle Asset Management Managing Director of Strategic Income. James, thanks so much for joining. So first of all, we are seeing investors lock in those yields today and potentially tomorrow and the next day as well. Is it a surprise to you that we're seeing, say, the 10-year benchmark yield down almost below 3.8% at the moment?
Yeah, we actually had a 375 at year-end for our year-end call, so we're within a couple basis points. But as we've been messaging, and I think people are finally gathering, that the peak of the Fed or the end of a Fed tightening cycle is unambiguously good for bonds. You go back to the last 5 tightening cycles, which bookend my career, you see that they dramatically outperform the cash markets. And so what people are waking up to is when the Fed does move, banks will move, and those cash investments that have to be redeployed will start to evaporate in terms of their yield. So duration is definitely your friend. I would say the 10-year is probably going to relax a little bit when we start 2024. But this has been an extraordinary couple months for the bond market. I like to say the year of the bond really turned into the 2 months of the bond, and we're going to end up with a pretty good return in fixed income.
It is pretty fascinating. Now, your view is that the rate cuts on the table, whether those be the 3 that the Fed have on the table right now or the 6+ that the market has on the table, are not necessarily a done deal. Who's right, you or the market / the Fed?
Well, it's interesting. We go back to the pandemic experience when we had the misinflation call, the transitory, quote unquote, and we put so much omnipotence onto the Fed, and it's probably unfair. Inflation is a difficult thing to measure. Our best analysis is suggestive of goods inflation actually falling and rolling over, and service inflation is continuing to be high. What surprised me a bit, Sonali, is that we had the victory declaration, or the appearance of a victory declaration, now, because the data to us over the last month and a half isn't materially better on the inflation front. So I do think the Fed wants to take a few of the insurance hikes off the table, but a 6 or 7 or 8, real reversal of the Fed cycle in 2024 to us is not in the offing.
Well, even if you don't think that the Fed is going to hike again, this idea of rate cuts that the market has been pricing in, to what extent is an increase or a reacceleration of certain parts of inflation still a risk to investors going into next year, given that they've recalibrated so drastically?
To us, it's a very big risk. And what's interesting about Powell's statement, and this is something material because he changed his wording, at least in our estimation, that the 2% number, or inside a 2% number, was no longer the goalpost. That he said he could loosen monetary conditions prior to that. What I would simply suggest is the inflation animal has some inertia to it, right? Labor markets are still tight. I believe COVID forever changed the labor management dynamic. I think there's still a lot of wage pressure that has inertia to it. We're seeing on the services side, on the real estate side, owner's equivalent rent. I mean, there's still some inertia on the inflation side. And more importantly to us, the consumer, even though rate of change is moderating at the inflation level, we are still at very, very high levels in terms of absolute numbers. And so what we look at is a slowing economy, perhaps a recession, at least that's our call, a modest recession, and a Fed that's likely going to have to react to that. But they're doing that absent any material slippage in the labor market, and that's unprecedented. So to us, we'd like to see a little bit of softening, maybe some pretty good softening in the labor market before I'd say, victory mission accomplished for the inflation fight.
How much does the relative story matter here, James? To the extent, say, next year you start to see the ECB or other central banks around the world cut before the United States, then all of a sudden you have a higher rate differential moving forward. How much does that make a difference?
Yeah, I think it's going to make a big policy difference in terms of competitiveness of dollar. If we get a real strong dollar and crimp exports because of the interest rate disparities, I think that will matter. But to be sure, the Eurozone and other markets are in a world of hurt right now / recession. It would be unlikely that we would have this much tightening, this steepness of tightening with lending standards tightening, loan growth slowing. It would be the outlier not to have a slowdown / recession juxtaposed against those dynamics. But it's certainly possible. This is, if you were going to make an argument, sometime is going to be different. Maybe this is the time, but my history tells me that we're still likely into a slowdown type territory to start 2024.
James, is monetary policy restrictive?
Is monetary policy restrictive now? Yes, finally. And I would suggest to you that that's only happened over the last quarter or so. If you look at financial conditions generally, if you look at the lagged effect of these tightenings, I think you're just starting to see the teeth of it. And I think maybe that's where the Fed's going here. If I can steal a Wayne Gretzky analogy, the puck is going to an economic slowdown. Perhaps they know that. Perhaps they know the last couple of hikes were insurance hikes at the margin, and those are the ones that will likely come off. But a widespread cutting in rates to reaccelerate an economy, given the inflation backdrop to us, is not likely.
Are you concerned about anything related to the fixed income markets, repo markets, and so on in the next even 12 months at this point, James? There's a lot of talk about what might happen if deficit concerns increase, for example. I mean, the Fed has been reducing its balance sheet for, 18 months now?
Right. I'm absolutely concerned about what we call fiscal dominance. We've got numbers that you've reported on wonderfully at Bloomberg, as always, but that can be a narrative that the market may grab hold of. Heretofore, they haven't. We have 33 trillion in debt. You're seeing interest expense now at an average of around 3%. That's going to go up. You're seeing the profit taking, if you will, from the quantitative easing mathematics between Treasury and Fed going away. You're seeing tax receipts marginally declining, and obviously the adjustments to the entitlement program. So all of that conspires to make an environment where the bond market could have a little bit of a knee jerk and move higher. Our best guess is Q1, Q2, we see a relaxation of yields in the 10-year Treasury, meaning they go higher. That's going to be, for those that have missed it, if they have, a great entry point into fixed income, be it municipals, be it credit, be it some of these dividend stocks that have really lagged the market that are now starting to rotate into favor. It's interesting that the income space up until 2 months ago just looked horrible from a return standpoint, and we're going to end the year with a balanced, dividend bond strategy approaching double digits. But for any long-term investment policy, that really does hit the mark. So it's really been a huge about face over the last couple of months. But I think those that think they missed the fixed income trade, they're going to get another bite at the apple in the first quarter, at least in our estimation.
You were talking a little about duration earlier, but how much duration are you willing to take on, given some of those large fiscal concerns, the tightening by the Fed? How much control is there really over the long end of the curve, and how much danger is there when you look past the 10-year?
Yeah, Moni, I think the intermediate part is the sweet spot, especially on the taxable side. If you look at the credit markets, the double B, triple B areas that we like to play with a duration of around 4 and 5, those are still a 6% type handle yield. The conversation is a little bit different on the muni side because of the demographics, because of the supply-demand imbalances, and because the muted nature of municipal volatility generally. So we're a little more constructive on duration there. But to your point, the MOVE index, the measure of Treasury volatility, unlike the VIX, the measure of equity volatility, is still extremely elevated. So the highway of interest rate outcomes for the 10-year is still very wide. So caution on duration, particularly on the taxable side, is warranted here.
How much caution do you have when it comes to steepeners as well? You have had investor after investor pitching buying curve steepeners going into the end of the year, except for if you look from the beginning of November to now, we've actually inverted quite a bit on the 210 curve.
Yeah, and we continue to invert with that clock ticking between inversion and recession, which we know is one of our tells that has failed us at least up till now at this point. I don't think the 10-year eclipses 5%. I think the 4.99 will be the high water mark this cycle. I think the range is going to be that 3.75 to mid 4s for the next couple of quarters, and I'm comfortable owning treasuries in anywhere in that range for the next 5 to 10 years.
James, the other thing that you point out is that credit bonds in the triple B and double B sectors still offer 6% yields. Are you happy with those? Are you looking for opportunities in that arena?
Yeah, I think the case for the double B sector has never been stronger. Since 2009, defaults have almost been non-existent in that space. And what we've learned through this period of very, very low interest rates is corporate America has gotten very comfortable functioning in those double B, triple B areas. We've had a number of upgrades in the double B space. We have what we call rising angels, accreting up into the triple B space. And when you can sort of, to us, that's the sweet spot of yield and credit, those two sectors, which encapsulate roughly half the IG market, roughly half the high yield market. You don't have to go way down the stack. And if you look at a 6% yield, Sonali, and you look at that relative to equity risk premium, and you look at that relative to most folks' investment policy or investment objectives, that's hitting a lot of marks. And we think that that's going to be, especially for balanced investors, a very good entry point in that particular area, along with some of the agency and agency-backed mortgage securities, which spreads have gotten very wide because of the vol in the Treasury market. There's some yield out there to be had, and let's not put it under the mattress. Let's not get too comfortable with these money market rates, which have been nice and been attractive, but they're going to be fleeting if the Fed and the markets are going to be true to what they're telling us up to now.
Certainly a volatile time in Treasury markets and fixed income markets overall, but finally a little relief when we're looking for returns. Our thanks to James Camp of Eagle Asset Management. It's interesting, Vonnie, when you think about the credit plays here, you have people pitching a lot of duration here, more than they are credit risk, but you and I were talking on the sidelines a little earlier that high yield has actually been a great performer into the end of the year. The last 2 months have really given a bid to that market.
Exactly, and I'm sure there are people out there waiting for the fall falling angels. They haven't fallen yet, many of them, but likely will in the coming quarters. And there you just heard James talking about rising angels. So we will have both sides of the coin, Shonali.
Yeah, absolutely. And, you know, it's interesting here, too. We'll talk a lot more about those fallen angels. Even on the equity side here, it's looking pretty ugly out there. You have to have a stomach to invest in this market. Now, coming up next, we're going to talk about the retail industry. We're going to be joined by J. Michael Prince, CEO of US Polo ASSN, for their retail outlook for the year ahead. This is Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets. I'm Shonali Basak alongside Bonnie Quinn. We're going to talk about the consumer because early data shows that U.S. holiday retail sales rose at a slower pace than last year, and that's according to MasterCard Spending Pulse. Joining us now to discuss those retail trends is J. Michael Prince, Global President and CEO at US Polo ASSN, a $2.3 billion retail fashion company. Michael, when you look at that slowdown, how is it impacting you and how are you getting around it?
Well, you know what? I think that the math's fairly consistent from what we've seen. And let me give you a couple highlights on our brand. So we have a $2.3 billion global footprint that spans across 190 countries worldwide. So we have a really good perspective, not only in the United States, but abroad on what trends are working, what's not working. And what we saw coming out of Black Friday, we saw very strong online sales. But then it slowed down as you got closer to the Christmas holiday and was steady thereafter. But online was up kind of mid to high digits, single digits, where our retail sales at brick and mortar were basically flat to slightly up to slightly down, depending on the market you look at. But what's interesting is that we also have to factor in inflation, right? So let's say inflation's been up 5 to 10%. Some of the reports are saying retail sales in total were up 3%, 6% online. If you factor out inflation, then basically it was roughly flat, give or take, this year versus last year.
How do you think about the setup into next year? When we think about the U.S. consumer, on one hand, there is a little optimism there around the direction of inflation, but they are levered to the knees, right? They have more than $1 trillion now of credit card debt here in the United States alone. How do you think about that dilemma?
So, Nolly, I think it's a real dilemma, and I think there's been a disconnect the last year within the marketplace. As you mentioned, and so well said, inflation's high, interest rates are impacting all of us, and the consumer is strapped. The credit cards are maxed out. A lot of the consumers are putting their purchases on platforms, pay over several months. And so it's going to be really interesting about 2024 is how does the consumer hold up, knowing that you always run up a lot of credit card debt going into the holiday season. Do they pay it off over time? Do they pay it off quickly? Do they have the ability to continue to consume? Now, one thing I think great destinations, retail destinations like a Walmart that focuses on great discounts, or even a brand like ourselves, which has a great price to value proposition for working families, I think we'll be okay with this. But I think you're going to see the consumer pull back post-holiday across a lot of spending platforms.
Michael, how did you deal with inventory post-pandemic, and are you at sort of quote-unquote normal levels now? And also the supply chain, are you seeing any issues to do with current supply chain issues?
Well, one thing with inventory levels, and I think we all learned a valuable lesson during the pandemic. We were over-inventoried, then under, then over, supply chain issues. There was kind of a reckoning 12, 18 months ago. I do feel like retailers are in better inventory shape this year, ending the holidays and going into next year than maybe they were in years past, just based on lessons learned. For us, US Polo ASSN, we're a very, like I mentioned, price to value proposition. So we really focus on the basics. We'll have some fashion items, but a core basic polo shirt, white, red, blue, black, will sell 12 months out of the year. And so therefore, we feel good about our inventory position globally because we've been focused on the basics. If you went very forward fashion and a fashion item didn't resonate with the consumer, then you could have some challenges liquidating that inventory. You mentioned supply chain. One thing we do watch very carefully, being in 190 countries worldwide, is the items that are happening or the actions that are happening around the Red Sea. It's one of the top 6 trade routes in the world. We have a large Middle Eastern business between Turkey and some of the Middle Eastern countries. So that's something that hasn't impacted us yet, but we're keeping an eye on it because it is something I think most vendors and retailers should be watching.
Yeah, Abercrombie & Fitch coming out and saying that they were going to actually fly some of their products as opposed to ship them because of it. I'm also curious as to your thoughts on real estate, because you say you have 1,100 retail outlets and stores, locations, let's say, worldwide. Are there places where real estate might actually be looking attractive at this point?
I think in places where you have a soft economy, if your brand's performing, I do believe there'll be opportunities. Western Europe comes to mind, where it's a slow growth market, and we see opportunities of landlords to get good rent rates for extended deals. So that's something we'll look at very aggressively. I believe in the U.S., and you guys have seen this trend, the Class A malls are still extremely expensive, hard to get into. They make sense where you can make money. Class B and C are harder, and then the outlet centers are still performing well. So for our retail season, inline was good, but outlet was really strong as we expected. And so the better outlet centers, and I think Class A mall space will still be tough, but there's always deals to be had if you're patient and you have a strong brand.
You mentioned Europe a little earlier. How are you thinking about a potential slowdown in Europe, let alone the United States as well, given that we have not yet seen the brunt of a recession?
Well, great question. When we look at everything globally, and that's how we forecast the year, and you'd mentioned $2.3 billion, that was 2022. We just delivered $2.5 billion this year in 2023. We'll make that formal announcement in the next few weeks. When we look at the markets around the world, we see the U.S. still being healthy. The consumer's a little more strapped than we'd like, but I think for our brand, we'll hold our own. India, we just became the largest power brand in India. We think that's $1 billion opportunity for us long term. So India marketplace is really strong for us right now. Western Europe, I will tell you that from a retail perspective, I believe they're in a slight recession already. So I think 24 will be you're flat to slightly down to slightly up. And the Chinese economy is still soft as well. So we've seen some softness in China, in some of Asia as well. So that's how we're kind of looking at next year. U.S. and India, some of the other markets kind of flat to down a little bit.
How do you also think about the dispersion in the types of consumers? You think about the setup for 2024 and concerns around luxury even, but then we speak to other kind of luxury brands, say Norwegian Wool we just spoke to yesterday, and they can't keep things around fast enough, things are flying off the shelves. So what are consumers doing across different levels here?
Well, I think, I'll call it kind of lower middle income, working class family down, has had a challenge the last 6 months. And those are some of our customers. And we appreciate the fact that we can offer them a great price to value proposition. But I think with gas, interest rates, inflation in general, groceries, it's tight for that demographic. And we understand that. And it's not only tight in the US, but worldwide. In Q3, we saw softness around luxury for the first time in years as well. A lot of the really strong luxury brands reported soft numbers, especially in the United States, which kind of surprised me. And I'll be interested to see what happens at retail for the luxury providers Q4 around holiday. So, Nolly, to your point, I think really strong brands are going to always perform better than others. I think the brand you just mentioned must be one of those great strong brands, but just your average luxury retailer, it'll be interesting to see. I think they're going to be a little softer than the market had planned, and that Q3 kind of transition continued.
Michael, you have a huge background at places like Cole Haan, Guess, also Nike. I do have to ask you as an outside observer now, what is Nike getting wrong?
You know what's interesting about Nike, and that's where, I always say it's one of the top 2 or 3 brands in the world. I kind of put Apple and Nike as one of the top 2 brands out there. And they've always been strong with innovation in the brand. And what I've seen happen with some of these new up-and-comers, On Cloud, Hoka, even like a Viore, Lululemon, they're chipping away at innovation and coming up with new interests for the consumer. And, I think that's something Nike's probably got to refocus on, is getting their innovation game back. And those new product pipelines coming out with product that every demographic wants a piece of.
Yes.
And brand's a great brand, but, they'll figure it out. But I do feel like there's a little blimp in the road right now.
Thank you so much for joining us and giving us so much time today. That is J. Michael Prince joining us there from US Polo ASSN. Still ahead, we look at the outlook for tech and AI in 2024 with Carl Szabo, Vice President and General Counsel at NetChoice. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of Villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
The island emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
We had some pretty tough talk.
bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report, tonight at 9:30 Eastern. Bloomberg, context changes everything.
This is Bloomberg Markets on Bloomberg Television and Bloomberg Radio. Welcome to both audiences. I'm Vonnie Quinn along with Shonali Basak, and at least we're positive an hour and a half towards the close.
Yeah, we are positive on some indices more than others, right? I think it's interesting to see that the S&P 500 has been struggling to hold on to those gains. We are near session lows, though the NASDAQ 100 still positive on the day, the SOX Semiconductor Index flat on the day, as well as the S&P 500, and the Russell 2000 up 0.3% still, Vonnie. So we are,
Yeah.
Yeah, absolutely. So we are holding on to some gains, but not with the same velocity. Of course, a thin volume day relative to yesterday.
Yeah, exactly. Maybe getting thinner towards the end of the week. In fixed income, we are seeing some activity as well. In fact, quite a bit of activity with investors locking in yields. Look at that, the 10-year at 379.07, continuing to descend. We have the 2-year yield at 424.16. And then in the oil markets, well, we all know that this is very likely about the Red Sea at the moment. Little bit of relief potentially, under $75 a barrel for a barrel of WTI. We are seeing just a tiny bit of a premium in gold markets right now, 2,077.33 for an ounce. Well, a ban on the sale of Apple Watches has been put on hold by a U.S. federal appeals court. Here now with this and other Apple and related news, Bloomberg's Mark Gurman. So a ban on the sale being put on hold is a relief for Apple. Do the watches start to get sold again? How does it work in actual practice, Mark?
That's exactly what we're trying to figure out right now. We are waiting to hear back from Apple. We have been refreshing the Apple online store. We have been checking Apple's physical retail stores and people who work there. There's no update as of yet on when the watches will return to sale, but obviously getting this reprieve via this emergency order through an appellate court in D.C., that definitely puts the watch on track to probably go back on sale today. Through January 10th at minimum. January 10th is when the ITC is going to respond and try to shoot down this motion. But this particular court in D.C. has a history of not granting these emergency lifts if they don't believe that this will stick long term. So as of now, it seems likely, if I were a betting man, that this Apple Watch ban situation should be resolved by the middle of January.
Incredible turnaround story. But you have Massimo Corp. This is the company that had brought the patent infringement claim against Apple, now down about 5.4% on the day. What does all of this end up meaning for them?
Yeah, for the stock, you probably had a lot of people. You saw the stock has been up over the last month or so, buying into Massimo twofold. One, on a more basic level, you've heard about a new company. You heard about their technology. This has been an incredible marketing moment for Massimo, so that probably brought in a lot of consumer investors and day traders and such. And then on the other hand, you had a lot of people jumping into Massimo because they became under the impression that maybe there would be some sort of licensing pact or settlement from Apple. Massimo generates about $2 billion in revenue on an annual basis. You know, a settlement with Apple would probably be worth hundreds of millions of dollars and would probably juice the company's market cap. So people were excited for that potential. And now that you see this appeals court has stepped in, that makes a settlement all the more unlikely. I don't believe that's something that would happen unless there's a circumstance in which the U.S. Customs Agency rejects a software-based fix, right? A hardware fix could take several months. And in that case, Apple would probably need to settle with Massimo to avoid losing out on, let's say, 3 to 4 months of sales of the Apple Watch. Softer fix, that's a matter of weeks. So I think for now, investors are scared off, and they'll probably really be scared by the middle of the month if the softer fix is indeed approved by customs.
I want to also talk about another story here, this idea that OpenAI is leaning on Apple talent, a veteran of Apple, to work on AI devices. We've been talking about these devices for months now, the possibility of them. What does it mean to bring on this kind of talent for Sam Altman?
Yeah, so it's unclear if this is OpenAI related or if this is more related to Sam Altman and more of an independent venture. He's starting this new company with Johnny Ive, who's Apple's former chief design officer. He's credited with designing almost every iPhone, Apple Watch, iPad, Mac to date. He worked on their headquarters as well. He's one of the 5 most important people, maybe 3 most important people, other than Tim Cook and Steve Jobs, in the history of Apple. And he has this new company called Love From that he started 4 years ago. And he's working with Altman on AI devices. And so far, Johnny Ive has hired over 20 former Apple employees for Love From, his design studio. And most recently, Tang Tan, Apple's current vice president of iPhone and Apple Watch product design in their hardware engineering group, he's leaving Apple in February, and I'm told he'll be joining Love From to lead hardware engineering of this Ive and Altman hardware company.
It's a fascinating story, Mark. Can't wait for more of your reporting on what comes next, a suite of devices potentially. Also want to direct people to your great story about the 1 a.m. email, which started the whole Apple Watch saga. That's Bloomberg's Mark Gurman. Let's turn now to Carl Szabo, who's Vice President and General Counsel of NetChoice, also Professor of Internet Law at George Mason University. Carl, thanks for joining. Perhaps you'd sum up 2023 in AI regulation for us and maybe set the stage for what might happen in 2024.
Yeah, thanks for having me. 2023 was a big year for tech. I mean, look at the Magnificent Seven. But 2024 is when the promises become real. We've heard every CEO, whether it's Carnival Cruise Line to Apple to Facebook, talk about AI and make these outlandish claims. Well, now in 2024, we're going to finally see those claims become reality. We're starting to see artificial intelligence finally be integrated into Office Suite solutions. So on Microsoft or Google Cloud Services, we're going to start to see AI Copilot become live and help us write better, create better, and do our economic analysis better. But it doesn't stop there. We're starting to see artificial intelligence be injected into things like healthcare to figure out better ways to optimize finances, to create better medical treatment, or something as simple as transcribing notes for a doctor so they spend more time talking to patients and less time looking into computers. And then, of course, the legal space where I am is going to be heavily disrupted by AI for the better. We're going to be able to put law students to work out of law school, actually writing briefs rather than spending time doing discovery and poring over court documents, because we can use artificial intelligence to offset that. So 2024 is when the promises of AI become reality. And a decade from now, we're going to look back on our daily use of AI and wonder, how did we live without it? Much in the same way we look back now as to how did we live with life before the internet.
Yeah, I mean, there's all sorts of promises, but there's also the promise or a threat, depending on how you look at it, of regulation. What happens regulatory-wise in Washington, D.C. next year?
Yeah, that's the thing that I'm keeping a close eye on, and we're keeping a close eye at NetChoice on every single day. So let's be crystal clear. The artificial intelligence is heavily regulated today. We have hundreds, if not thousands, of laws that apply to artificial intelligence right now. And that's because the way the United States has always done laws and law enforcement. We don't outlaw technology or devices. We outlaw bad actions. So if you use AI to commit fraud, if you use AI to commit harassment, we have laws today that apply to artificial intelligence. It's fraud and harassment. But unfortunately, there are many in D.C. that are looking to regulate, that are looking to create laws or new federal agencies to create new regulatory red tape for artificial intelligence. And this is being led by a lot of the fears surrounding artificial intelligence. I think, fortunately, we are starting to move past this whole notion that AI is the Terminator or AI is Skynet. And we're starting to finally begin to realize that AI is just a tool. But unfortunately, there are many in Europe, there are many in DC that are looking to create rules to regulate artificial intelligence rather than looking to enforce the existing laws that we already have today. What does that mean for businesses?
On that note, too, I mean, this idea that there are waning fears about it, we did see tons of strikes this year that invoked the idea of AI and the disruption that it has to certain industries. What about just even plainly the job market, let alone any potential ethical concerns around the use of AI?
Yeah, every time there's a new technology, we always hear concerns about jobs or loss of jobs therein. You roll back 100 years ago when the camera came around. We were worried that it was going to eliminate the jobs of artists. Well, artists are still around today, and in fact, cameras have created a whole new profession called professional photography. The same is true with the combine in farms, and the same thing will be true with artificial intelligence. Will jobs be changed? Absolutely, but new jobs will be created because I'm not a good artist, but artificial intelligence can actually help me create the types of images that I want to use in my tweets, in my blogs, and in my writings. So that's the way artificial intelligence is actually going to empower many of us to be more creative and to actually create new jobs. So will jobs change? Absolutely, but we're not going to eliminate radiologists, but if you're a radiologist who doesn't understand how to use artificial intelligence, then you're going to be in trouble. So what we need to do is recognize it's a new tool and begin teaching how to use AI in schools.
Right.
How to use AI in medical schools.
That all makes sense. However, there is also a sense here that most of the major industries in the United States have grown under the weight of some regulation with some guardrails. And the ones that have not, say the banking industry, for example, ended up failing for a hot minute there. And so when you think about the regulation of AI moving forward, how do you make sure that it's regulated, but also in a way that can grow the industry responsibly so that it is a net positive for the economy?
Yeah, it's something we're also looking at NetChoice on a daily basis. What we are seeing is actually a lack of enforcement. And if we get enforcement of our existing laws as they apply to artificial intelligence, that will send a clear message to the industry that you can't just hide behind a computer and pretend that you're not committing a crime. Let's use a simple example of Sam Bankman-Fried, right? He was sent to prison not because he used Bitcoin, but because he committed fraud. And that sent a clear message to the entire Bitcoin universe that you cannot engage in fraud via Bitcoin and hope to escape justice. The same message needs to be sent crystal clear to the artificial intelligence industry. If you're using AI to engage in illegal discrimination, that's a crime and it should be prosecuted. We don't need new laws. We need better law enforcement. And that's how you create the guardrails, is by making it crystal clear to anyone using or developing artificial intelligence that just because it's new doesn't mean it's unregulated. And that's the solution that we're encouraging across the board. More law enforcement, less government regulation. Because one of the things that does concern me is we're seeing a lot of lobbyists flock to DC to try and make sure that their company is allowed to prosper at the expense of other companies. And that's really scary because that's actually going to create less innovation. And it's going to give less of an opportunity for that next great piece of technology in artificial intelligence to come into fruition.
Carl, thank you so much. That is Carl Szabo of George Mason University and also NetChoice. Meanwhile, a little bit of trouble ahead for Tesla potentially, or at least something interesting. IT security researchers from Berlin Technical University say they've gained access to Tesla's autopilot system. Now, this is according to the German newspaper Der Spiegel. These researchers are saying it's not going to be possible to manipulate the autopilot of other people's parked Tesla vehicles. At the same time, Shonali, it's not really a vulnerability you want to have if you're allowing a car drive itself. And I'm not sure that I would trust that if somebody has access to autopilot that, you know, they wouldn't have access to my autopilot.
Yeah, no, it's certainly a big concern of what it means to have a hacker be able to, for example, gain access to it as a consumer ramification. But also, interestingly, the researchers say that competitors could significantly recreate parts of the autopilot system. And speaking of competitors to Tesla, we have this amazing story today on the Bloomberg terminal about a massive competitor out in China. Who knew that the Chinese auto market was booming so drastically, such that they would take the place here of Tesla across the world?
Well, I have an answer to that. You know who knew? Warren Buffett knew way back in 2008 because he bought a stake that was representing about 10%.
I've forgotten that.
Do you know how much that stake has grown since then?
Tell me.
35-fold, and he's been getting out of it. He's out of it.
I have been waiting for Bonnie Shinali trivia on this show this week. So.
BYD, honestly, it's incredible. Tesla also, of course, making many of their EVs in China, so it's not as if there isn't the, established knowledge in China for making EVs.
You know who didn't see it coming? Elon Musk, who had said to Bloomberg in 2011 that he did not see this as a.
He didn't see it then, but bear in mind, what was that, 13 years ago now?
Fair enough, fair enough.
These things move fast.
So coming up next, we're going to talk about women in economics. That's the focus of Wall Street Daily. Up next, this is Bloomberg.
What did you learn in the last 40 years about leadership in politics?
Well, I've been learning a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way: know your why. You have to know why you're doing this, because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about, so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back to Bloomberg Markets on TV and radio. I'm Shanali Basak alongside Bonnie Quinn. And it's time now for our Wall Street Week Daily segment. And Natasha Sarin, associate professor at Yale Law School, writes in the Washington Post that amid the signs of economic optimism ahead, there's one thing that shined very brightly in 2023, and that's the economic power of women. David Weston asked Professor Sarin about the power and key women driving it.
I'm actually pretty inspired as I look at this year and all the progress that's been wrought. And particularly, I think, and I talk about this in the piece, but if you look across fields, you see women trailblazing and trailblazing in uniquely female ways. So if you look at entertainment, you see Taylor Swift and the Eras Tour, which is going to be on track to be the highest grossing concert tour of all time. That's brought $6 billion to the US economy. So much so that world leaders around the globe are begging Taylor for a tour stop. You have Beyonce, whose Renaissance tour has brought billions to the economy, who brings a Beyonce bump to every city that she tours in because her fans, literally bedazzled in silver, turn up, ready to celebrate her, and particularly support women-owned businesses in every tour stop that they attend. You have in economic policy, one of the steadiest hands of Biden's cabinet is Secretary Yellen, who is the first person to hold the 3 most significant economic policy roles in the United States as her current job, Treasury Secretary, as chairwoman of the Council of Economic Advisors, and as chairwoman of the Federal Reserve, who's at the forefront of really pushing towards the implementation of our transition to a cleaner, greener economy, who is leading the IRS or working with the IRS to modernize its technology and improve the service that taxpayers receive. And you have in the world of athletics, the Spanish women's national team, which won its first World Cup this year. But if anything, that's sort of a small victory relative to what it's been able to accomplish off the field. In the wake of sexual assault that players experience, the players turn this into an opportunity to really leverage and fight very deeply for equal pay, for women's rights, and to kind of push for the types of progress that for too long it's been very hard to attain. And so this year, I think that we're kind of at the precipice of something really exciting in the economy, which is growth and our understanding of that growth being propelled by women.
All of that is terribly important and really exciting. And you left out the first time in history when a woman by herself got the Nobel Prize in Economic Sciences, in Claudia Golden, somebody I believe you've worked with. So tell us about that and why that's so important.
And you know, Claudia Golden is a superstar and became this year, as you point out, David, the first solo female recipient of the Nobel Prize. It's even more exciting, though, that her Nobel is for her work on understanding women's role in the labor force. And in particular, when Claudia was coming up as an economist, she graduated from the University of Chicago in 1972. There weren't that many female economists. And so as we became interested in the study of the family and family economics, Claudia realized there was an incredibly important story that was missing from not being told. And that story was about the role of the wife and the mother and the ways in which social norms and expectations and access to certain types of progress would really come with the kind of gender equity that so far in the economy we haven't been able to see. And Claudia's work has really inspired a legion of economists who do economic history, who study women's roles, and also has really pushed us to understand the ways in which the workforce can evolve most usefully exactly to attain that type of equity. And one of the bright spots actually of COVID that Claudia has pointed out in her recent work is that maybe exactly the type of flexibility that's giving us the opportunity to have this interview on Zoom today is exactly what's critical to allowing the world to move to a place where it creates economic environments and work and labor force that's really supportive of all of its members, and that includes women.
So I want to jump back, if we could, to Janet Yellen, who has had, as you say, a truly extraordinary career, no doubt about it. You said a steady hand in governing the economy. Is it a successful and steady hand? Because right now there are a lot of Americans who are not very satisfied with where they think the economy is. Is she succeeding?
No, I kind of find this year, and it's kind of how I started the piece, which is there's been a lot that's been discussed about the ways in which consumers are really facing and have been facing for many years an incredibly difficult economic environment. We've dealt with the shock of a once-in-a-generation pandemic in COVID. We've dealt with, hopefully once in our lifetimes, frankly, we've dealt with the world of rising inflation and higher prices for consumers. And now, finally, prices are starting to come down. Inflation is starting to come down. And you're in a world where unemployment is still low. And yet, there is this sense of lack of optimism about the economy. And I suspect that that's totally understandable, and that's actually what you would expect in the situation that you would expect us to be in, given this shock that we have suffered from. That said, this administration and Secretary Yellen is at the forefront of this, has really been working to try and make the situation for American consumers and American workers an improved one. Inflation, as I mentioned, is falling. you're in a situation where Secretary Yellen in particular has been an ambassador for the administration across the globe. And one of the points that I make in the piece is that she kind of led an effort to have a conversation in China this summer that predated an incredibly important moment for President Biden and Xi Jinping. And I really think that the way in which she has leveraged her understanding of how the economy works, her understanding, frankly, and her deep empathy for the American people, and her stature abroad has made her tenure incredibly successful. And we're all, frankly, very lucky to have her in this role.
Natasha, you lay out a lot of the success stories of 2023 for women. Let's talk about an area where it looks like there's a lot of progress yet to be made, and that's the C-suite, at the CEO level. You have included in your piece Mary Barra, who in many ways is the dean of the female CEO. She's now been there 10 years as CEO. She's had a bit of a rough year, as you point out, explain, but she really has done, many people think, really monumental work at General Motors. At the same time, last time I checked, if you look at the S&P 500, it's still down around 10% of the S&P 500 has women in the job. We now finally have Jane Fraser, a woman running a major bank. But if you look on Wall Street, you look around the C-suites generally, there's a lot of progress yet to be made, is there not?
There absolutely is, and you're right, that number is around, it's slightly above 10%. It's been rising, so that's exciting to see. But we've been in a world where Mary Barra is the first woman to run an automobile manufacturer. Jane Fraser is running a very significant U.S. bank. We're in a world in which you're starting to see progress on dimensions that are incredibly important. And it's an exciting world. I also talk in the piece about Barbie. And I say that it's been really important for it. Barbie was the largest grossing film of the year. Barbie kind of celebrates and embraces the messiness of Barbie herself, the doll, the ways in which the doll created unrealistic expectations for women about what they should look like, but also the ways in which it was exciting for young girls to be able to look at Barbies and see themselves and imagine themselves as Supreme Court justices and imagine themselves as business tycoons. And as you look at Mary Barra and as you look at sort of female executives writ large, it is really exciting for women like me to be able to look to them. Granted, their tenures are rocky. It's really difficult to transition the world to a green economy with automobiles being manufactured fully electrically, in her mind, by 2035. It's hard to look at that world and not be sort of incredibly excited about the fact that this transition is being led by women, and it's being led by women who embrace and sort of celebrate the fact that they are women, and that grants them a particular window into the American consumer, into the American labor force, but also particular insights about the ways in which you can lead and lead successfully.
And that was Natasha Sarin, Associate Professor at Yale Law School. You can watch more Wall Street Week Fridays at 6 p.m. Eastern. Well, coming up, we're going to be speaking about the outlook for M&A deals in the year ahead. We'll speak with Rob Brown, CEO of Lincoln International. For all our Bloomberg Radio listeners and Bloomberg TV watchers, this is Bloomberg.
In a couple of drugstores, even in my area, which is not the poorest area in Washington, D.C., it's a nice upscale sort of area. When I want to get razor blades, you have to go to the front of the place and ask somebody to unlock it. Why are you locking up razor blades and other things that I might want to buy?
Yes. So, this is a national problem. And, this isn't, random theft. This is organized crime. And, state legislation has put guidelines on, how much the theft that you can steal before you're convicted. So it's a $1,000 limit. But we have been partnering with other retailers and sharing our camera feed. I know some of our partners here from Walmart are here, but we are all part of an organization that's coming together that says if you've, we can put our camera feed together and tell that that person has been in our store, in their store, and the numbers are higher than 1,000. So we've been able to impact these theft rings most recently.
What are the things that are unlocking key the most? What are people trying to steal the most, other than razor blades? I guess?
You know, I will tell you, it started at razor blades because that's such a high ticket item, but you know, it's a lot of cosmetics, but really what happens is that they take advantage of what I would call the elbow move, and they just come in and swipe a counter. And so it's just a matter of categories now.
This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
For our TV and radio audiences worldwide, welcome back to Bloomberg Markets. I'm Shonali Bassick alongside Bonnie Quinn, and we're looking at a market here, Bonnie, that is just trying to hold on to the Santa Claus rally here. It is about flat on the day, but we have been flirting with gains and losses here. We've been whipsawing a little bit on the S&P 500, and even the NASDAQ 100, where there was a little bit of a bid earlier in the day, you are seeing that waning as well. The stock semiconductor index actually now down 0.1%. And the Russell 2000 still holding on to some gains, up 0.2%.
Yeah, we do have about 47 companies making 52-week highs, so there are good stories underneath the surface. But as you say, Shonali, the S&P down about a point right now, but I wonder if we'll finish the day higher. I mean, volume is low, but I'm sure there'll be some activity going into the close as well, which is why you're watching us. I do want to point out that yields are being locked in very substantially. We're at 378.70 on the 10-year. Looking at commodities markets, oil is coming off a little bit, but then look at Bitcoin. We are reversing yesterday's reversal, so we're up 1.9% now on spot Bitcoin, 43,150 or so, as I guess the retail community and the institutional community await those decisions on potential ETFs. And we'll be speaking with Eric Balchunas a little bit later on, Shonali, about all of that.
Yeah, we'll keep an eye on that Bitcoin ETF watch, and we're going to switch gears now to talk about a story that on and off air I'm sitting around calling all the investment bankers around today, because deal makers, they're coming to the end of their worst year for mergers and acquisitions in a decade. Now, the value of global M&A is down roughly a quarter in 2023 to $2.7 trillion, missing that $3 trillion mark. This is all according to data compiled by Bloomberg earlier this month. We're going to bring in Rob Brown, the CEO of Chicago-based investment bank Lincoln International, because perhaps one bright spot here is that middle market where a lot of private equity activity is happening and expected to rebound next year. What does that pipeline look like, Rob?
So the pipeline for next year looks much improved. The private capital markets or the middle market were not unscathed by the slowdown or the air coming out of the balloon a bit after record 2021 and 2022. But there is some cause for optimism in 2024.
Now, if you think about the optimism, one thing I wonder about is where the money comes from. Rates are still quite high. Yes, things are starting to stabilize. They're higher than they've been in the last decade, really. And private credit, while that has been an interesting channel the last year, there's an expectation that even their defaults will start to tick up a little bit. Is capital as available as it seems on the surface?
Yeah, I think capital availability is less of the issue. I think there is lots of dry powder sitting in the private equity world. There's lots of cash sitting on corporate balance sheets. And as you point out, the private credit markets have a good deal of capital to put to work. The issue is more value. I think as the cost of capital rose more rapidly than anybody expected, it had an effect on values. And it's just economic theory. When the cost of capital goes up, values come down, and markets take some time to react to that. So it's a bit of a stare down between buyers and sellers right now, with some external forces, putting pressure on both returning capital and putting capital to work.
Yeah, exactly, Rob. I mean, we've seen a lot of, particularly in private equity, a lot of write-downs and a lot of sort of, revaluations of stuff that's already on the books. How are companies valuing themselves these days? What kind of metrics are most important?
So there's two things they look at. They look at fundamental performance, which has held up very well. I mean, we're not seeing widespread business performance issues either at the top line or the bottom line, really across any sector. So when we look at the private capital markets, business performance has been relatively good. The issue has been multiples. And as I said, as the cost of capital has gone up, the multiples have come down a bit. Now, you also have to put this in context that a lot of private equity groups, they didn't write their assets way up when the market the public markets were moving materially up. And so they have further to write down. But I agree with you. I think there is going to be an ongoing kind of revaluation of some assets sitting in private equity.
Now, you're actually looking outside the United States as well, and I know countries like India, Singapore, and Vietnam are very interesting to you right now. Why is that? I mean, we've seen a run-up in India already just in regular market valuations. Is that part of the reason?
That's part of it. I think India is a particularly strong beneficiary of people wanting to de-risk economically from China. And I think there's a view that whatever geopolitical tensions there are with China are likely not going away soon. And while China will always be an important economy, many Western companies are looking for alternatives. And in India, it's the largest democracy on earth. It's largely based in English and in English common law. And so we have a very large and successful office in India. In fact, we did an acquisition earlier this year. And we're seeing increased economic activity there just because it's a higher growth economy, but also I think looking around the globe for companies that were in China, where else can they go? India is a big beneficiary of that.
There's a lot of uncertainty around China, including geopolitical uncertainty. There's a lot of geopolitical uncertainty in the Middle East, where a lot of financing has come from in recent years. How much does that have the potential to throw a wrench in some of the optimism we're seeing into next year?
I think less on the financing front. I think a lot of the sovereign wealth money has made its way into private equity groups that's committed capital already. There are direct investments, and maybe those slow down a bit. I think the bigger issue is on the macro economic front. I think one of the things that happened this year is we are starting to see a pickup in activity in Q3, and then the crisis in the Middle East happened, and it just, as people were just starting to maybe be a little more risk on. That came onto the geopolitical stage. And I think the fear is that the U.S. and other countries get pulled into something more broadly. So I think that effect potentially, it's a little bit of a black swan event, but that potentially has a bigger effect than at least in our markets, financing out of the Middle East, just because a lot of that is already committed through global private equity funds.
So what about this idea of private equity? You had mentioned earlier buyers and sellers and meeting in the middle here in terms of negotiating. How much power does the seller have in this market, given what we're seeing in terms of compression of valuations?
Yeah, I think the seller has less leverage. I think, and that's part of just it takes time for maybe sellers to realize not only what's the current valuation market, but what's their leverage. And I think you're coming off of many, many years where the sellers had all the leverage. They had highly competitive processes. They had multiple bidders at very high values. And if you blink, they just go on to the next bidder. And that has changed a bit. I think buyers, even if they're willing to pay the price that a seller wants, the buyers have more leverage. They can dictate timing. They can dictate structure a bit more. They can dictate what they're going to do in due diligence. So I do think that, and interestingly, we did a survey of thousands of private equity groups, and we just got the results back. And over 70%, I think it was 72%, feel that this bid ask between the buyers and sellers is going to continue to rectify, and that you could see an opening up of the floodgates in the back half of 2024. So I do think that if anyone blinks first here, I think it's going to be the sellers, not the buyers.
Yeah, I was just going to ask about that survey, Rob, because why the second half? I mean, we've had bank CEOs promise for a return of M&A activity for a couple of quarters now. Is it not going to happen until the Fed starts cutting rates, or what will be the catalyst?
I think you will see an improvement even in the first half, but I think what you tend to see in our market is it's not linear growth. It's kind of an exponential growth. And once buyers and sellers start seeing activity pick up, they kind of flood back to the market. So I do believe as things have stabilized and the fear of a deep recession has passed and the fear of further interest rates increases have passed, you are going to see an increase in activity throughout the year. I think what's expected is a real acceleration of it in the back half of the year.
Rob, we thank you so much for your time. It has been obviously a tough year, but a rebound en route. That is Rob Brown, CEO of Lincoln International. We're going to turn our attention now to the outlook for ETFs in the year ahead, and one of the most highly anticipated events in expected weeks, about 2 weeks' time, when the SEC is likely to approve the first spot Bitcoin ETFs in the United States. We're going to bring in Eric Walchunas of Bloomberg Intelligence to talk more about this. Eric, what is the risk here? I like how you call this the Coin-Tucky Derby here, where there are a certain number of issuers here in the making, including some very, very large ones. How important is it for them to get out of the gate, and based on their preparation here, who's going to be the most successful?
Get out of the gate, I like it.
I didn't even think about that.
I'm glad you guys like it. That's the third attempt. I tried to get Bit-Tucky Derby. Everybody trashed that. And then the Bitsurrection. But Coin-Tucky Derby just feels right. And it is a horse race. You know, I've been covering ETFs for almost 20 years, and there's never been a situation where multiple ETFs were launching on the same day that did the same thing. So it really comes down to the variables, right? Who the company is, how their distribution is, what their fee is, what the ticker is. There's a marketing, how much they're spending on marketing. This should be an epic marketing war. So I think we're going to see maybe 6 to 8 make it to the starting gate. Here's the thing, there's a last step involved right now, which is getting authorized participants signed agreements. I won't go into the details, but you need an authorized participant to run an ETF. And there's been a little bit of an issue with everybody getting theirs on board. So it's possible some don't even make it to the starting gate. Then there's Grayscale. Possible they don't make it either, based on if the SEC decides that it would be unfair to let them go with everybody else, because they would come over with $20 billion in assets and about $150 million a day in trading volume. So if they were to start or convert their trust into an ETF on day one, they would have a massive advantage. So the clear favorite would go from BlackRock Fidelity to Grayscale instantly. So there's a lot of variables at play here.
Now, what about this idea of other types of ETFs here? Obviously, we have not seen much by way of a Bitcoin ETF this year, and we've actually seen, varying success when it comes to the Bitcoin futures. But a lot of the love was in plain vanilla bread and butter ETFs tied to the S&P 500, I believe.
Yeah. So the top 3 flow-getting ETFs of this year were what I affectionately call the 3 amigos. SPY, IVV, and VOO, which all do the same thing, the S&P 500. Now, it's interesting, the S&P 500 up 25% this year. Those 3 ETFs took in their biggest share ever. So as much as we get carried away with things like Bitcoin, so much of the money just goes to what we call cheap beta. It is where the real big cash goes. And why not? I mean, there was a Bloomberg article about a week ago about how every trading strategy was unable to beat buying and holding the S&P. The only thing that beat the S&P and an ETF that fascinates our team constantly is the Qs. The Qs is up 53%. I mean, that's ridiculous. I mean, this is talk about something nobody called. The question going forward for us is what happens now? Because we all said the Qs couldn't do this again, especially in a high rate environment. It did it. Now what happens? If you're an active manager, do you go to small value now? This is going to be a really tricky year, in my opinion, in terms of whether to load up on Magnificent Seven or just completely get out of them. One ETF we're watching is equal weighted ETFs, RSP. That is a way to get your exposure to equities without that huge Magnificent Seven overweight.
Eric, were there any complete flameouts this year?
Flameouts. Yeah, I mean, look, a lot of the inverse leverage ETFs didn't do well. You know, most everything was up. I think one thing that didn't work was some smart beta and active. When you have a year when like the Qs are up 50% and everything's going well, it's tougher for active, especially when a couple stocks carry it, because active's brains are wired to go for value and things that are quote underpriced, they're undervalued. And a lot of smart beta ETFs are wired that way too. So a lot of them lagged. There was barely anything negative, but a lot of things did lag, of course. So I would put active, smart beta, and if we had to pick one loser of the year, probably ESG. ESG saw outflows. You know, it was the talk of the town 2 or 3 years ago.
Yep.
And man, the bloom has come off that rose. Outflows this year. The lack of energy hurts it.
The tide really turned on ESG. Eric Balchunas of Bloomberg Intelligence, thank you. Coming up, it'll be our Muni moment. This is Bloomberg.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
From New York City,
From London and Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Bloomberg Markets coming to you on Bloomberg Television and for your listening pleasure on Bloomberg Radio. I'm Bonnie Quinn along with Shonali Basak. Time now for our Muni moment, and today we're focusing on the financial health of smaller U.S. colleges. They're being hit with rising costs and falling enrollment. Bloomberg's Nick Quirolo has been covering this story and joins us now. And Nick, thank you so much. Take us to this story in an anecdotal way. So tell us, for example, about Albion College.
Sure. Albion is a school that last week ran into some financial difficulties. Like many of these schools, they sell debt in the municipal bond market, and their debt fell into distress after they broke 2 covenants in their debt agreements based around some of their financial ratios. So it's just a great example of a small school in a rural area that's really feeling constrained by some of the demographic changes we're seeing in the U.S.
Yeah, and what does it then tell us about the landscape more broadly, Nick? If this is one school, is it just, you know, one anecdote, or can we extrapolate from there?
No, I think investors and analysts in this space have been watching pretty closely, and they expect a lot of instances like this. There are fewer children being born in the United States. There's less of a value proposition around a U.S. degree nowadays, and a lot of that is translating into fewer applicants and fewer students in seats. And realistically, the United States is facing a problem where many of these small schools that draw particularly from small regional areas are going to have to start to target new types of students or find new revenue streams because the pressures are mounting on them.
What types of schools are facing the most pressure here, and what are the biggest issues here? Is it the cost side being the bigger issue or the enrollments themselves?
I think the really big issue stems from enrollment and admissions. So we wrote a story a couple weeks ago trying to measure about every small school in the United States, and we talked to quite a few experts who advised us that some flags that you might want to look at include an acceptance rate and a yield rate. Are more students applying? Are they accepting more students? And are fewer of them saying yes to those offers? You want to look at long-term enrollment trends. Are they losing students consecutively year after year? Are they losing money? What's their operating margin? And how much are they giving students in aid to get them through the door?
What is the end game here? Put this issue into context. If the smaller schools in the country are facing this type of financial stress, what is the direction of travel?
I think that there is a bifurcation happening. That's really how the experts talk about it. Your name brand schools, your Harvards, your Yales, these are schools that are seeing their acceptance rates drop. They're becoming increasingly competitive, and some of them are selling 100-year bonds. They're going to be here for as long as any of us can realistically think ahead. But then on the opposite end of the spectrum is you have these schools that are small, maybe less brand recognition, and not as competitive. And realistically, they're probably going to start to close. Fitch expects 15 to 25 closures a year going forward. And that has implications for investors who are holding college debt, for parents and students who are paying tuition, and for the scores of people that these colleges employ.
Yeah, Nick, you mentioned some of the Ivies there. We all know that right now there's plenty of donors that are at least threatening, and some have already decided to take away their funding. Does this potentially benefit smaller colleges at all, or does that funding just go away?
I think the funding, those are probably separate issues, but I think really what the big issue on the small colleges radar is just the enrollment trajectory in the United States and how they are able to, diversify themselves away from your kind of traditional liberal arts offerings.
So, Nick, just more broadly now, November saw the best returns to municipals since basically the Paul Volcker era. What's the outlook for December and January and into the first quarter?
A lot of muni market investors are watching pretty closely. Obviously, December is a notoriously quiet period in munis. We have seen rates pretty aggressively high and ratios pretty expensive. So I think this is a pretty exciting period for muni investors, and most of the people I talk to are talking about all the tax advantages. Obviously, income on municipal bonds is tax exempt. We are hearing a lot of excitement in munis.
Where is the opportunity here and where is the pain? I mean, we started this conversation off about the school systems facing such pressure, and it really begs the question about a resolution process. I mean, municipal bond investors, how much more pain is there really to be seen in this higher rate environment?
I think there probably will be some. A school closure is a really difficult, complicated process. One great example is a school that we wrote about in upstate New York called Cazenovia College. They had about, I think, upwards of 30 million, 50 million of municipal bonds outstanding. And when the school closes, it really becomes kind of a graveyard for the investors. They are the people who tend to have the highest ranking on the assets of the school. And the school assets are pretty complicated. Like, think of an endowment. A lot of people give to an endowment and they earmark their money. That's not something that an investor can necessarily tap into to make themselves whole on a bond. So these are really lengthy, complicated processes. They usually involve lawyers, sometimes state attorneys general. But as we start to see these school closures, we're probably going to see, like I mentioned earlier, some bifurcation, some schools really coming away from this that are able to successfully pivot into new types of programs, whether that's career-focused or new master's programs or something that a lot of the schools we talked to brought up. Those schools will probably see some strengthening, and schools that aren't able to pivot or find new types of revenue streams are going to probably struggle a little bit.
You know, to Vani's question about these broader questions about the muni market, just a couple of weeks ago, we had reported that BlackRock is one of the large players that believes that the broader rally in the muni market is likely unsustainable. So what's the setup going into next year?
Yeah, I mean, there definitely have been some headwinds. One big story that we've been focusing on a lot is Citi's announcement that they're closing their public finance department. They were one of, for years, a massive, gargantuan player in this market. And over the last decade or so, we have seen a steady decline of muni bond underwriters working in the municipal world. This is something that comes up on almost all my interviews. Investors are really concerned about kind of the implications, particularly around liquidity. Citibank had this reputation of being a reliable bank who would come in and provide liquidity, especially in really challenging times. So thinking the pandemic, when there was all this massive sell-off happening and nobody could find holders for the debt. We probably will see some other banks. I think we wrote a profile about Jefferies really rising up the ranks in the underwriting tables for munis. They have taken some real market share there. But obviously, this is a really tumultuous time as we're starting to see, big banks think about and talk about what is the future of their public financing, how profitable is it, and what's the outlook?
Yeah, it was fascinating. I was going to ask you about whether there were repercussions. What about ratings, Nick? Will there be re-ratings at all if the Fed moves on interest rates substantially next year as the market expects, or even the 3 times that the Fed is anticipating right now?
So for credit ratings, particularly in munis, the issuers tend to not be very rate sensitive. It's a little bit separate from your traditional fixed income market in that way. You think of like a local government, for instance, they need to build a new bridge or a road. They tend not to, because these processes move so slowly, they are not very sensitive to swings or trajectory in interest rate because these are very demanding less time sensitive issues. So if a government's going to build a bridge or a school is going to issue bonds, they tend to do it on their own timeline based on their need, not necessarily the interest rate environment.
Our thanks to Bloomberg's Nick Carollo. We appreciate your time so very much. And please read the story by Nick on the Bloomberg Terminal and online. Very thorough read on what's going on in the American school system. Now, Vani, I want to point to markets a little bit as well here, because what's interesting is we've been talking a lot about equities here, but we also have to talk about what the setup is moving forward, because even though we're seeing some weakness in the dollar, there are a lot of questions about whether that is an up arrow or down arrow move into next year, given not only the Fed's rate cuts, but relative to what you would see in Europe. I think it's a big question mark, and a lot of people have been burned on that trade throughout the course of the year. The yen also, after a historic move we've seen here, a lot of questions about what happens with the BOJ next year. Interesting setup. The gold rally has also been pretty stunning alongside that Bitcoin rally. But again, that gold question, they make a point on Bloomberg's M Live here that the gold rally here could really face some structural headwinds when you think about the trajectory moving forward into next year relative to the dollar.
Well, and it's interesting you bring it up because it is very potentially the fact that we will move to a currency story next year from an interest rate story. I mean, obviously, interest rates will still be, the main topic of conversation as the Fed decides whether or not to move. But dollar index below 101 is pretty standout. And of course, we didn't have any economic data today either. So
yeah, absolutely. We have the hedge funds really trading those currencies and the macro. But up next, we're going to talk about the housing market instead. Stay with us. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Welcome back to Bloomberg Markets. I'm Shonali Basak alongside Bonnie Quinn. We're about a half an hour until the market close here, and we're looking at an S&P 500 that has been wavering all day long. We have been looking at the Santa Claus rally, fading a bit here, about flat on the S&P 500. We're looking at the SOX Semiconductor Index, pretty much unchanged on the day. The NASDAQ 100 also pretty flat on the day. The Russell 2000, though, still getting a little bit of a lift up, more than 0.2%, Bonnie.
The 10-year yield, Shonali, down more than 10 basis points in the session, trading at 379.07. The 2-year yield at 423.96. Investors just looking for that end-of-year gift and locking in those yields. The 3-month T-bill at 538.58. We've crude oil now down more than 2% at 74.05. There's a little bit of relief potentially regarding Red Sea concerns. And then right now we're looking at gold there, spot gold at $2,077 an ounce.
And as we think about rates, we have to also talk about the U.S. mortgage rates because they continue to fall for the third straight week. And it hopefully opens up the market for more sellers in the housing market. We spoke to Mark Raphael, Saint-Gobain North America President and CEO, last week on the market.
I think last time we were here, the rates were going up, and there was a question if it went up another half a point, what would happen? And we really believe that because the environment's underbuilt, you know, we talk about a rate of about 1.7 million to meet existing demand per year, and you know, anywhere between 17 to 20 million underbuilt over the next decade. So there is this demand. So rates going down will create, I guess, more people selling their homes and more into the marketplace and more R&R activity. But I think regardless, we've seen today that even with high rates, you see good demand. If interest rates go down a little bit, people feel, you know, 8 was bad, 5 looks good.
So it's really about getting sellers to want to sell.
That would help rotating the market. When you talk affordability, I think when sellers start selling, you get more homes in the market. Right now, you have a lot of new build.
Is that 5%? Is it 4%? Remember, let's just say again, I have the 2.75% 30-year.
Yeah.
I mean, it's going to take a lot for me to, maybe a 4-handle, I'd think about it.
It's true. But I think, again, this is my perception that if you're going into the housing market and you're looking at a rate of 8, and used to be at a 3, now a 5 looks reasonable. So that will get people maybe getting mortgages and be able to get into the housing market. We see two big dynamics. I think about 40% of the homes are all cash owned now, no mortgage. And those people are selling and downsizing. So they're folks, you know, my age or a little bit older, retiring and downsizing. And so that's having a big impact. And we see the highest percentage of new build as part of the new homes right now because people aren't trading homes. So the new build, the big builders, you saw their stocks are way up, are building new homes, which is great for our business because that's building materials.
Mark, Brad Jacobs was sitting in the chair that you're sitting in right now a few days back. He just announced that he's going to be looking to consolidate the building materials distribution business in America and to a certain extent in Europe. One of the things that he was talking about is the application of technology to that business. He thinks that you could see significant technological improvement just in terms of warehousing and distribution and management and all that kind of stuff. How ripe is that industry, is your industry, for that kind of improvement?
You know, I think right now we sell through distribution. We have a lot of very good and large distributors we sell through, and they have a lot of technology. They have the ability for their contractors to measure a house, to use drones to take the measurements of the roof, to order directly from that activity. So there's a lot of technology in there. It's also a very hands-on business, distribution. So you have to deliver the products to the roof if it's shingles, into the building if it's gypsum in that area. So it's a complicated market. There's always a chance for consolidation, but I think the existing players in the market are very strong.
Where could things be improved on that end?
I think where we try to improve and where there's always an opportunity to improve is training of the trades. So, you know, if housing continues to pick up, we always say that it's a great career to be in construction products, to be in the construction industry. We need to train more people, and I think it's ourselves and distributors' responsibility to do that.
That was Mark Rayfield, Saint-Gobain North America President and CEO. And as you just heard from him, mortgage rates are dropping, now below 7%, and many economists expect that to continue to fall. We're joined now by Austin Allison. He is the co-founder of Picasso. And it's interesting because, Austin, when you think about the market that you operate in here, you're working on second homes, luxury homes, and matching buyers and sellers in this market. But how does that differ from what you're seeing across the broader American landscape?
Well, first off, thanks for having me. Yeah, at Picasso, we're a co-ownership marketplace that focuses on vacation homes. So we definitely spend a lot of time focused there. But we also spend a lot of time in the broader real estate market. And it's certainly an interesting time. Fortunately, the Fed, with the projected rate cuts, has given us a bit of good news to look forward to in 2024. But, you know, we'll see how it all plays out.
Do you have any initial expectations on how much?
Well, obviously, nobody has a crystal ball, but I think it's pretty safe to assume that rates are going to come down and continue to come down from where they're at today. If we can see rates in the mid fives by the end of next year, I think that would be, you know, a great place for us to be in. Even high fives is a lot better than where we're at today. But high level, I think it's safe to assume that rates are definitely going down, and that's going to be helpful. And beyond rates coming down, I think the other thing that's going to be helpful is just a soft landing. If we can see a soft landing in the economy at large, I think it's safe to say that consumer confidence will be higher than it is today, and that's also helpful for the real estate industry.
So, Austin, Picasso is fascinating because it's a sort of a new idea where you buy a portion of a house. I guess I don't want to call it a timeshare, but that would be the closest thing that we might think of in terms of the type of business model. You buy a portion of a house along with, you know, X number of other people, up to 8, I guess. And so you get it at a price where you wouldn't normally be able to afford a house in an area like that. Where are the hot destinations for 2024?
Yeah, that's exactly right. So Picasso is a co-ownership marketplace, and the easiest way to get your mind around that is imagine if you were buying a home with 2 or 3 of your closest friends or family members. Picasso enables you to do that, except for you don't have to know the other people. And we handle every detail, everything from design to furnishing to bill pay and maintenance. In terms of the hot markets that we're seeing, you know, it's really interesting. There's places like Volusia County, which is best known for Daytona Beach, which has seen 47% year-over-year increases, which is pretty crazy to think in a market like this that we're seeing 47% increases in a sub-market. But we are seeing that in places like Volusia and other hotspots around the nation. We're also seeing alternative destinations pop up that are proximate to major second home destinations. So an example there would be Bald Island, North Carolina, which is an alternative to Kiowa, which is a better known part of North Carolina, but much more affordable than Kiowa, which has been on the rise for quite some time. So I think as we look into the future, you can expect to see more of these second and third destinations that weren't previously kind of top of the list in terms of national second home destinations. I think you can expect to see some of those second and third tier destinations kind of ramp up to the top and benefit from continued price appreciation into 2024 and beyond.
For me, Austin, unfortunately, it's just another place to window shop, but a wonderful website and fascinating to look at the homes that you have online there. That's Picasso co-founder Austin Allison. Former UK Prime Minister Gordon Brown, Bloomberg opinion columnist Mohammed El-Arian and Nobel Prize-winning economist Michael Spence sat down with Bloomberg's Jonathan Ferro earlier this year. They talked about their book, Permacrisis, a plan to fix a fractured world. They discussed the impact AI could have on productivity.
When Gen AI came along, then I saw its sort of multi-domain capability, the fact that you can use it with no technical training, just a little bit of, practice, creating prompts, and its applicability pretty much everywhere. I thought, even though it's early days and we're in a period of exploration and experimentation, I think it's a reasonable forecast that this tool is an important part of a future productivity surge. And if it comes, it'll make it a lot easier to do inclusive growth patterns because it won't be a zero-sum game. It'll be easier to invest multi-trillions of dollars in the energy transition. It's going to be terribly difficult to get that done with fiscal space declining, the rising debt levels, and rising interest rates. So that's why we spend a fair amount of time. It's not that the growth by itself is the only thing. It's that it enables an awful lot of what we want to accomplish.
Yeah, I think we're heading for a low-growth decade if we don't have the productivity surge that AI can give us. And I think what Mike is pointing out is it can transform a whole range of industries. You'll never see the accountancy or legal or even medical professions or teaching profession be the same again if AI has the impact that I think and Mike thinks it will have. But equally, we've got to have that productivity surge, because without that, the inflation, the fiscal space being narrowed, the debt that we're running, and of course the supply side shocks and constraints that are in existence mean that as things stand, we're heading for a low-growth decade. AI is the way forward to take us out of growth, and I think Mohammed agrees with that.
No, totally. And it's critical because we have a debt issue that has to be resolved. We have an inequality issue. We need resources for critical transitions. So, the notion, as Mike and Gordon correctly said, that higher, more inclusive growth and more sustainable growth is a massive enabler to deal with all these other problems.
All three of you understand the risks involved, though. If globalization hollowed out manufacturing bases domestically in places like America, in the United Kingdom to some extent as well, and I'm asking the question, why wouldn't AI do the same thing to services? My question, if I'm a member, a citizen, someone who's got to vote, is why would I trust the same people all over again? Who should I trust to manage that transition and that integration of those technologies?
That's what my children say. My young teenagers say, you guys have messed it up. And it is true that we tried to create a more inclusive system. We tried to deal with the problems of the environment, but we couldn't get the agreement that we needed. And we tried to have more equity and better jobs. But I do think when I talk to young people, they want to see this change. The issue is not whether you have change or not now. The issue is what kind of change, and we've got to make that change inclusive.
Mike?
Agree. I mean, Eric Brynjolfsson talked about the Turing trap. The Turing test basically pushes you in the direction of automation. We want to push, in policy, should be pushing in the direction of augmentation, of giving people powerful tools that make them more productive. So this is the journey we're setting on, but it's not, I don't think, right to just capitulate and say productivity produces employment problems. It's at least more complicated than that, Jonathan.
But our global institutions have got to reform to be capable of dealing with this. They're not fit for purpose at the moment. And the IMF has got to be a crisis prevention mechanism to do proper surveillance of the world economy. It can't just be there for crisis resolution. The World Bank has got to become a global public goods bank and deal with the energy transition as well as human capital. The World Trade Organization has got to find a way of diplomacy and negotiation and arbitration working better than it has in the past. And we need a better concept of burden sharing. I mean, I cannot understand why, when you have a humanitarian crisis, and we have many around the world at the moment, all we seem to be able to do is pass the begging bowl round and hope that someone's going to produce some money. We've got to have a system of burden sharing, whether it's for the environment, or whether it's for public health, or whether it's for some of the other global public goods we want to do now. If you talk to people around the world, I've just come back from the United Nations, they all want this to happen. So what we need to do is show that this can yield the best results and then create the political will for this to happen.
That was Bloomberg's Jonathan Ferro in conversation with Gordon Brown, Mohamed El-Erian and Michael Spence earlier this year. So we're going to be counting you down to the closing bell in just a few moments. Michael Green is going to join us, portfolio manager at Simplify Asset Management. But we have to have a look at this market because wavering between gains and losses it is, but it really, really, really wants to not have a down day this week, I feel, Shonali. Right now, the S&P 500 is down a point, but, you know, we've got like 17 minutes to go.
Yeah, we do have 17 minutes to go. That is an optimistic view here, and you're right. The rest of the indices slightly in the green for the most part. I am so fascinated in that Russell 2000 bid because we are seeing that broadening of the market here. It tells you a story, doesn't it, Bonnie, that the S&P 500 is having trouble breaching where it was at its record. There are a lot of doubts about the sustainability of this rally. Maybe this is fair value headed into 2024, but we do have a few more days of the year.
Yeah, 2. And the rest of today. Stay tuned. More coming up on Bloomberg Radio and Bloomberg Television. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
This is Bloomberg Markets. I'm Bonnie Quinn along with Shonali Basak, and we're less than 15 minutes away from the market close, the Wednesday market close, the final Wednesday of the year. Joining us now is Michael Green, portfolio manager at Simplify Asset Management. And boy, Michael, even if volume is low or at least, under the average significantly, this market wants to close at a record, does it not?
Well, I think those two things are combined, right? So the very low volumes are in part telling you that nobody wants to sell and incur a 2023 taxation event. So they're desperately holding on for January 1st, which will give them basically a free year to decide what to do with the gains that they generated on the S&P or whatever other stock they happen to hold in 2023, preferably buying it near the lows in October.
Yeah, I mean, that would have been the absolute best case scenario. But Michael, so if they do decide to hold it over into the new year, is there a massive reallocation then, do you think, very early on in January, or at least a massive cashing out event?
It certainly would seem like there's the opportunity for people to take gains. I think it's going to depend, obviously, on the narrative that emerges in the first couple of days. If people start to see the selling, then obviously that could become self-reinforcing. But where we are right now is literally everything has now turned profitable for 2023. Bonds, which looked like they were in the cellar back in October, are now at a point where even they're profitable. Buyers of the long-dated Treasury ETF, the TLT, have now turned positive, despite the fact that they started buying in 2022 nearly 35% higher. So there's just no real losses out there for people to recognize. the incentive is for them to wait to January. We'll see if that ends up being the case, but it does seem like that's a logical point for the market to at least begin to the process of pausing.
Well, speaking of, if you think about when and how you would take profits in a market like this, what are you looking for?
Well, there's two components, right? So mutual funds in particular have a tax year that ends in October. And I think part of what we actually saw was the month of October was very much dominated by those names that had underperformed for the year being sold. Once that selling evaporated, it became far harder for stuff to go down, and it actually started to move upwards, causing short covering rallies, et cetera, that we've all talked about for an extended period of time for the past couple of months. And again, that's true in both equities and increasingly in bonds, in which many macro accounts that were of the opinion that interest rates were just way too low given the huge amounts of supply and the high levels of inflation we are experiencing, they're now licking their wounds and starting to be forced to cover as well on the other side. And I think those two components, that short covering and that unwillingness to take a taxable event, are contributing to what I would just describe as inelasticity in the market. It means that people are not particularly price sensitive. They have that large benefit associated with waiting just a little bit, a few more days to sell.
And 2 more days to sell, and a nervousness clearly, at least today, to buy a little more. But where you do see buying is still in the bond market. If you look at the 2-year yield today, it has dropped by more than 11 basis points. We are looking at a 2-year at 4.23 today. Where are the buying opportunities for you here when we have seen just such a rally?
Well, I think there's two challenges. One is, when we think about the underlying dynamics of that 2-year, which I've been a fan for, and in all fair disclosure, my firm Simplify offers an exposure through an ETF that is actually a levered version of that 2-year bond. So that's actually very well positioned for it. This is a much easier argument at 5 and change. It gets a little harder as you move down to that 4 level. You really are now very dependent on the Fed not only cutting, but cutting relatively aggressively. I do think that a lot of the narrative around 7, 8, 9 cuts being priced in is ignoring the potential for the markets to remain inverted. I continue to be of the belief that the level of interest rates that we're currently experiencing are high because the Fed has pushed them higher. The evidence that they should be here on an empirical basis is quite a bit less robust. And so I think that's part of what's driving the continued inversion, or near record continued inversion of the yield curve, is that this is a solution set that's being forced upon us by the Federal Reserve.
Well, what are you anticipating then in terms of cuts next year, Michael, particularly with that ETF that sounds fascinating, levered to the 2-year?
Well, so our expectation is as two things happen. One is as the Fed ultimately does cut, because they do seem to have made extraordinary progress, or we seem to have made extraordinary progress against the inflation bogeys. I don't actually credit the Fed a lot for that. I believe that most of that was supply oriented and generally reflecting the slow growth in the economy. Your prior guests were actually speaking quite well to that. But if I look at what should happen or what's likely to happen in 2023, it's probably an earn your coupons sort of year, where the odds are pretty good that the 2-year rate ends the year at pretty close to where it's starting. We just don't know yet how 2024 is going to play out from the performance or the standpoint of the Fed. If we see events occur in markets that create additional concerns about a further slowing in the U.S. economy, then the Fed may actually be quite a bit more aggressive. They have the capacity to cut by 75 basis points, just like they hiked by 75 basis points. That's something that's poorly reflected in the statistics, is the asymmetry that's available to them to cut more aggressively than most people are talking about with the series of 25 basis point cuts.
It's fascinating, there's still a wide disparity of views out there, and there are people who think that perhaps this inflation may even be stickier in certain areas, and that even if the Fed cuts, there is a scenario where it has to raise again. Do you think that's at all possible, Michael?
Well, it's obviously at all possible. I think it's a low probability event, right? And so the really critical thing that I think a lot of people tend to forget is they look at the historical level of interest rates that we saw, the 1980s, 15+% interest rates, and refer to that as somehow normal. The reality is that was what was truly abnormal. A level of interest rates in the 2 to 5% range has been something we've been trending for thousands of years as we've built surplus in our society. And I really just don't see the shortage or the incredible investment opportunities that would create that demand for borrowing money at much, much higher interest rates. I think you're actually seeing that play through. It's not just been that the supply of money in terms of cheap loans has fallen. The demand for money at higher interest rates has also fallen. That's why home sales were relatively depressed. That's why we've seen low levels of corporate issuance. The economy is just not set up to deliver returns that allow consistent delivery against these levels of interest rates. And so the odds are that we've probably seen the high in this cycle for both inflation and interest rates would be my assumption.
Well, speaking of interest rates, you know, to the extent that we don't see the level of cuts that the market is currently expecting, how levered do you think that the stock market is to rates right now? If we don't see those cuts, do we see a pullback, and what would that look like?
So I have a very non-consensus view on this, unfortunately. My general view is that stock markets no longer really care all that much about interest rates, except to the extent that they impact either collateral in the form of bonds or portfolios in terms of what they're holding in bonds. Throughout this entire cycle, we've actually seen the market capitalization of bonds and the market capitalization of equities largely move in lockstep. And I think that really reflects portfolio construction techniques that have become increasingly dominant, far more so than individuals sitting down, putting on their green eye shades, pulling out their calculators, and figuring out a discounted cash flow analysis on individual securities. This is really about how much have I allocated to bonds, how much have I allocated to stocks, how do they behave, and what's the return associated with them, and the rebalancing of those portfolios than it is any fundamental analysis on what's priced in, at least in my analysis of it.
Michael, you have a range of fascinating ETFs, from a tail risk strategy ETF to a volatility premium ETF. And in fact, one of them, one you mentioned, the short-term treasury futures strategy ETF, TUA, is on our Eric Balchunas' one to watch list for next year. I'm curious as to which ones of these you'd be most recommending yourself.
Well, I've been a strong proponent of TUA precisely because it provides you with leverage to the two-year bond. I also am, I think it's really important for people to consider the opportunities that have been created in the past couple of years to diversify portfolios away from simply equities and bonds. The alternatives category is growing very quickly. That's one of the things Eric also flags all the time. Our products there in the managed future space, CTA, our product offerings in the fixed income space with AgH and CDX, which both offer hedged bond exposure where you're hedging out the credit exposure. TYA, which is a similar exposure to TUA on the 10-year point, and also our commodities ETFs, things like hard, et cetera, equity long shorts. We offer strategies that allow investors to basically round out and fill out an exposure in a portfolio in ways that really weren't possible until the past couple of years.
Thanks to Michael Green of Simplify Asset Management. Complicated market setup into 2024. We appreciate your time. And Vonnie, we are so close to those closing bells. We are looking at a market that has been fluctuating all day long. Big debate here on whether we can end today in the green. Just a few minutes left. Count you down to the market close. Up next, Vonnie. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
last 40 years about leadership in politics?
Well, I've learned a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way: know your why. You have to know why you're doing this, because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about, so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
Emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
we had some pretty tough talk.
Bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report, tonight at 9:30 Eastern. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Markets. The closing bell ringing on Wall Street right now, this Wednesday session, and look how we finished. We couldn't help ourselves. Maybe thanks to low volume, but we are higher on the session. The S&P 500 at 47.81, 15 points away from that record, up 7 points on the session. So there was a little bit of a thrust at the end of the session. Fractionally higher, but up more than 1/10%, which is better than I can say for the rest of the session, where we wavered between a point or two of gains and losses. If you look at the NASDAQ 100, we're up almost 0.2% at 16,906. The broader NASDAQ up 0.2%. And the Dow up 0.3%. And we had plenty of companies that were making 52-week highs, including General Electric among them. And then, of course, we also had some of the chip stocks continuing to make 52-week highs, including Intel. In fact, in all, 51 companies. And they also included some sort of holiday vacation type companies, including Booking. And also we had Garmin making a 52-week high.
Worth talking about the sectors a little bit here as well, because not everything was in the green, given it was such a small beat on the day, if you will, Bonnie. We had yields plunging today, remember? So we had the REIT index rising more than any other. That was 1.7% higher. We had other indices as well that was up on the day, including home furnishing, gold, agriculture, but really some of the relief rally you were seeing here in those oil and gas stocks today.
For sure, and there was a big deal as well earlier in the natural gas area, so we can maybe examine that a little bit later on as well. Natural gas futures also higher today, having come off really pretty substantially in the last few days. First month futures up 2.7%. But I want to point to yields as well, because we had a massive leg lower once again across the curve. We had the 10-year yield now at 378.15, so that's down another almost 12 basis points. The 2-year yield at 423. Lots of buying in fixed income today as investors continue to try to lock in yield before the end of the year. And then I just want to point out as well that Bitcoin had a bit of a special day. It was up close on 3%, still only back to 43,508 per coin, but you know that's a little bit an anticipation of what might be determined regulation-wise when it comes to those spot Bitcoin ETFs. But joining us now is Adil Zaman, who's partner at the Wall Street Alliance Group. Are we going to make a record? It's, you know, a bland question, but we can't help ourselves at this time of year.
Yes, I think it is likely, because the Fed waged a war against inflation and it won that war. The economy is doing well, inflation is down. We anticipate that going into next year, this rally is going to continue because of upcoming rate cuts. And although because we've come up so much in such a short period of time, don't be surprised if we get some type of a pullback in the first quarter of next year, But people that have missed out on the rally, we think that is going to be an opportunity to take advantage of.
In what sense? So if you missed out on the rally, and we're looking at the Magnificent Seven, let's say, the Nasdaq 100 up 54% this year. I mean, if you missed out on that, would you really test those waters next year?
I think the Magnificent Seven is going to continue to be magnificent, because just in this environment that we are in, with an increased focus on artificial intelligence and cloud, I think some of those stocks will still have momentum to go ahead further, especially on a pullback. But we do think that the breadth in the market is going to improve, and there's going to be the skinny bull market is going to fatten up a little, and other sectors are going to participate. And we really feel that some of the yield-hungry investors, because of rate cuts, are going to gravitate towards the dividend-paying companies. So a recurring theme for us going into next year is to take advantage of some of those good quality dividend-paying stocks.
You have started to see the breadth of the market really start to broaden. You think about the Russell 2000 today alone. I look at the growth versus value in the Russell 2000, and even that gap has started to narrow in recent weeks. Do you think that continues, or do you think that there is going to just be more emphasis placed on where the herd has already been going, the semiconductor stocks, the AI boom, and those Magnificent Sevens?
I think it's going to be pretty much all of that, right? I think that, probably the speed at which the tech stocks have gone up, that's going to slow down. But I think the tech stocks are going to continue to do well, right? But I think there's going to be greater participation from other sectors. Like, for example, right now, the cheapest sector in the market is the energy sector, right? And with rate cuts, the demand for oil is going to go up. Prices of oil, we anticipate, are going to go higher. And there's going to be supply constraints because of geopolitical factors, because of OPEC production cuts. And we do feel that, there's consolidation going on in that space, which you just spoke about. And I think that's going to benefit some of the big players.
How do you play the energy sector at this point in time? And what are the stocks that you would be buying in the sector?
So a stock on our watch list that we really like here is ExxonMobil, right? So through that deal with Pioneer, the merger that they're having, they're going to benefit from economies of scale. And what we will start to see, Exxon itself has said that by 2027, they anticipate that their earnings will double based on average oil price of $60 a barrel. We think oil is going to be a lot higher. So I think that's, and the stock pays a dividend of north of 3%. So I think those type of large companies we feel stand to benefit in this environment.
Adil, why do you think that oil is going higher? I mean, we're awash in oil, we're awash in natural gas. OPEC said we're cutting, and the market said, okay.
So we think that, if we take a step back, right, and we look at the bigger picture, we think that, this transition away from fossil fuels is going to take time. And with rate cuts, we are going to start to get an economic expansion. And we feel that if you take a longer-term point of view, by 2045, we anticipate that the world economy will more than double, right? And geopolitical constraints will continue, OPEC production cuts will continue. So in the long term, we think that's going to be a driver for oil prices to continue to rise.
What other areas, and are you talking about near-term gains? So like the first couple of quarters before the Fed starts to cut rates and then everyone's attention gets turned elsewhere?
I think that, this breadth in the market has legs. I think it's going to last. We feel that, the sectors that we like are dividend-paying companies across the board, high-quality, good-quality businesses that pay a good dividend, right? So, for example, if we look at a company like McDonald's, which is on our watch list, fantastic business model. I mean, their franchise business, they're getting recurring fee from franchise fee plus rental income, and which is a high margin business for them. They've done really a great job in the international markets by catering to the local flavors. And if you look at the dividend history of this company, for the past 47 years, year over year, they have increased their dividends. So we think that those are some of the areas that the investors are going to gravitate towards, which have legs here.
There is a lot of optimism embedded in your trades that you are putting forward. But what happens if the market turns? What happens if the job market turns faster, or the consumer breaks at a faster rate? What happens to those trades?
I think that, that's definitely always a risk. So what we always recommend to clients is have a well-diversified approach. This concentrated approach may have worked for this past year, but being well-diversified not only across sectors in the stock market, but I think gold is a great hedge for those type of scenarios, because if there's volatility, if there's geopolitical tensions, gold tends to do well in that environment. And what we like is the SPDR Gold ETF GLD in client portfolios, which gives that hedge. Also, having some fixed income exposure provides that hedge to portfolios as well in this environment.
How are you entering the fixed income market, and is it purely a hedge or is it an investment at this point?
For us, the fixed income market is mainly a hedge. We do think that as rates go down, fixed income should do well. But for us, fixed income gives stability to the portfolio in volatile times. But for the equity portion of the portfolio, that's where we are focusing on for the growth. And we see a lot of opportunities there.
Anything outside the United States, or are you purely invested in the US? There's a lot of opportunity potentially out there.
Yes, we do think that the global markets should do well, that there's opportunity in some specific areas. We specifically like companies that have the international exposure. We spoke about McDonald's. Another company that is in that same theme would be, for example, Caterpillar, right? So when we cut rates and there's economic demand expansion, there's going to be more construction projects. And that means that a company like Caterpillar, which is the world's largest construction equipment manufacturer, would benefit from it. And then Caterpillar also has a great dividend history. For the past 30 years, year over year, they have increased their dividend, and they have an international presence as well. So that is a stock on our watch list that we also like that plays. So to answer your question, focusing on good quality companies that give you that indirect international exposure is what we like.
And I notice you're looking at financials as well, but if all these stocks are on your watch list, that means you haven't actually got in yet. Are you waiting for more attractive levels for them?
These stocks are on our client portfolios, in our different client portfolios, but we are also looking for them on pullbacks to add exposure there. So that is why. But yeah, we like all these companies. We do have exposure to them.
Now, we were talking a little bit about kind of the strength of the market going into next year, but the risk. You still can't discount the risk here moving forward. How would a deeper recession start to change your thinking here?
So I think if we go into a deeper recession, obviously the growth area of the market is going to be vulnerable, and obviously some of the big tech, that has had tremendous run-ups there would be vulnerability there. So the idea is that this is the market where there's a lot of active trading that is going to have to be done. So to trim positions on a rally, to add positions on a pullback, I think actively managing portfolios, rebalancing portfolios, and making sure you're well diversified and not concentrated, those would be the strategies that we would be following to safeguard our clients.
Certainly a trader's market. Our thanks to Adil Zaman of the Wall Street Alliance Group. Meanwhile, Wall Street's love affair with SPACs has been ugly this year, with Bloomberg estimating that $46 billion in losses have been wiped out of equity markets with SPAC markets here, and 21 firms have gone bankrupt already. Bonnie, WeWork being the worst of them, seriously.
Yeah, WeWork was, it's a head scratcher because it's one of those things that you sort of anticipate, not just WeWork, but sort of all of these bankruptcies, or maybe not bankruptcies, but failed SPAC, public listings or what have you. And yet they come and it still seems like a massive surprise. 21 former targets went bankrupt. They destroyed a huge amount of value. Remember Lordstown Motors, Shonali?
I do remember Lordstown Motors. Remember Bird, the scooter company?
Well, I was shocked that Bird was bankrupt.
Especially shocking here because you saw Bird really go from 0 to 60 in terms of its valuation, really one of the fastest.
And you're not talking 60 million.
No, you're talking about $1 billion company here, pre-SPAC. And one thing here, I think this is such a relevant conversation after today's market close as we reach a new record high, because exuberance sometimes leads to massive losses.
But there was so many warnings, about the exuberance. And is it always the same? Maybe it's the same about the Bitcoin ETFs now. There is warnings out there, right? But I don't know. It just feels like, was there really not, was there exuberance for these SPAC deals? Wasn't it just that there was exuberance for the creation of them?
There was so much excitement about them on the front end, and then you saw things really start to turn when certain banks stopped underwriting them. Do you remember that?
I do remember
There
that.
was a moment at which even the banks said we can no longer do this, and the market had flown away from itself. But I really do beg the question here, at new record highs, is there still exuberance hanging out in the market that can lead to losses that look a little more like what we're seeing with what happened with the SPACs?
Yeah, I mean, it's not funny, but, you know, Lordstown said that they had a backlog of 38,000 vehicle pre-orders, and it turned out that they had literally sold fewer than 40.
Incredible.
I mean, it's incredible. And there are court cases going on, and Hindenburg Research has been pointing out in this specific instance about Lordstown, but we'll see through the court cases if, you know, shareholders can help recover their losses. Do they deserve to?
You know, it was a very enter-at-your-own-risk situation here, and the breadth of industries here that we're seeing the bankruptcies in is incredible as well. Now, coming up, we're going to talk another turbulent industry. We're going to talk about the banks, but only one big bank has managed to stay ahead of that pack. We'll talk about that next. All the details. This is Bloomberg.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology. And welcome to Balance of Power. This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets, and I'm Shonali Basak alongside Bonnie Quinn. Now, everyone is focused on what the Fed will do next, including, of course, Bank of America Chair and CEO Brian Moynihan. David Weston, anchor of Bloomberg's Wall Street Week, spoke to him last week.
We have the #1 research team in the business, and Candace and the team do a great job. They just shifted yesterday, literally, and they moved to more rate cuts in 24. But the real key was, what do they see in the economy? And they basically have moved from a 0.5% growth rate annualized for the first 3 quarters of next year up above 1%. So they've softened their soft landing, let's just say that. And by doing that, they've said when the Fed is seeing inflation slow as fast as it is, they basically think we get down to the low 2s in inflation by the year, and next year, 24, and it carries into 25. The Fed needs to bring the rate structure down. They're saying basically 200 basis points of rate cuts, 100 next year and 125, which still leaves you at 3.25, 3.5. Now, the last time we were fundamentally at that rate structure was it was 18 years ago by the time we get there. So we've had a long stretch of very low rates, except for what happened very recently. And so that fueled a lot of activity. And now the rate structure can be fundamentally higher. It's more structurally sound. And the Fed it's not really pivoted to say we got to normalize this because we're seeing the economy and the inflation come in. Not done yet, but all indications are doing there. And everything we can see that consumer spending is consistent with a 2% inflation economy. That level of spending growth in our customers was where it was in 17, 18, 19, when the Fed raised rates to bring the economy back in sync.
Are you concerned at all that the markets may be overreacting to what they heard from Chair Powell?
I think he's got this challenge that, he was, the Fed in their own mission was late to cutting off inflation. Now he's going to be careful not to be late to stop cutting off inflation. And the market's going to ebb and flow. But I think people have to be a little careful. This is trading talk. This is, the 10-year moving around between, 390 and 450 and 470. It's not the real economy. The real economy is still heavily impacted by the overall rate level. It's very restrictive, and it's still coming through the system. Against that, we still have a lot of stimulus coming through the system. Yep. The Infrastructure Bill, the CHIPS Act, the IRA, those are all still coming through the system. So that's a tug of war he's up against. But overall, we believe he's engineered a soft landing through the interest rate environment.
That was Bank of America Chairman and CEO Brian Moynihan with Bloomberg's David Weston. Now, Bank of America may be up about 2% for the year at this point, part of a turbulent year for most banks across America. But we saw the biggest U.S. bank failure since the 2008 financial crisis. And yet there's one big bank that ended the year way ahead of the pack. Joining us now is Bloomberg's Sally Bakewell to talk just about what J.P. Morgan was able to accomplish this year. And it's time now for the post-mortem, isn't it? Because on one hand, J.P. Morgan made out like a bandit here, right? They were able to really add a very significant amount of assets, significant clientele. Does everyone think that's fair?
I think, yes, JP Morgan is in line for its biggest annual profit in the history of American banking. It was able to, rescue First Republic, making it even bigger. And I think what that does is, raises one very interesting question. What will the, banking landscape look like in 2024? We have seen a lot of consolidation this year. As banks collapsed, we saw Silvergate collapse, Silicon Valley Bank collapse, Signature Bank also failed, and PacWest was bought by a smaller rival. The question is, do we have a landscape of further consolidation? And, do regulators want that amid the sort of too big to fail concerns that sort of swirled around when JP Morgan bought First Republic? Well, we know that Treasury Secretary Janet Yellen in May said that, in this environment, when there's pressure on earnings, that may lead to concentration in the sector, and regulators will likely be more open to those mergers. So when it comes to a question of fairness, I think regulators probably think, well, what is the least ugly hit for their deposit insurance fund? And JP Morgan was able to offer them a bid for First Republic that, ultimately posed the least cost to that fund. And, consequently, in their minds, that's helpful to the taxpayer.
I'm going to read a comment here from Lee Raymond, who was on JP Morgan's board, spent 33 years on JP Morgan's board, and he said there's a certain level of frustration from other banks. When things get kind of in tough shape, it's an opportunity for somebody like JP Morgan to acquire some things that they would like to acquire but aren't in a position to. Do we just watch the big get bigger here, and is that a good thing for American banking?
Well, again, JP Morgan, it's the biggest US lender. It could use its mighty balance sheet to beat competitors and, again, spare regulators an even uglier hit. During this turmoil, the big, heavily regulated banks, they stood out as sort of beacons of relative safety, and they attracted customers' cash. And then, of course, that of course attracts a lot of criticism. The government, has been making efforts to keep the largest banks from getting bigger through acquisitions, and there are rules that bar those with more than 10% of the country's deposits from buying other deposit-taking institutions. But of course, there are exceptions, and those exceptions came into play earlier this year. So again, I think it comes back to the question of what regulators want the banking landscape to look like next year, and a lot of regional lenders are facing the same sort of pressures that they saw earlier this year, although I think the less aggressive, now that the interest rate hiking is probably done, that does ease some pressure on their deposit costs. They don't have to maybe fight so hard to keep depositors from fleeing to high-yielding assets, and it probably eases some of the pressures on their investments. The confluence of those two things, caused a number to fail earlier this earlier this year. So I think just how it all shakes out in 2024 is going to be the biggest and most fascinating question.
Sally, if you were of a mind to defend some of the other big banks, I'm not sure why you would be, but if you were, you could make the argument that this was JP Morgan's year in a sense, right? That the things that happened this year perfectly suited JP Morgan, whereas for some of the other banks, deal making wasn't really that hot, for example. So some of the better deal making banks, wouldn't have been able to take advantage of that. Citi was very distracted doing other things and so on.
Yes, it definitely suited JP Morgan. It didn't make the big bet on sort of treasury bonds and other supposedly safe assets like banks like Bank of America did. And it's interesting, we just heard from Brian Moynihan just there. Bank of America is now contending with significant unrealized losses because of its decision to invest sort of in a bigger way in those securities. And so, yeah, JP Morgan was, found itself in a much more favorable position from that perspective. And as the biggest bank, it was able to put in a bid for First Republic that was for the whole of the bank, and that's what regulators wanted, and that gives it a significant foothold in sort of the First Republic's client base. It is also going after the void, or going into the void created when Silicon Valley Bank collapsed, and of course, the VC or the fintech or the tech kind of clients. It's going strongly after that customer, which will no doubt be a boon for it. And of course, it attracted a lot of depositors who were sort of spooked by what was happening at smaller lenders. So it really has benefited this year, and those things, it should still continue to see sort of the positive impacts of those things into next year. And then, yes, we do have the deal-making environment. We've had this very prolonged deal-making slump, which we're headed for our worst year for M&A in a decade, and banks like Goldman Sachs and Morgan Stanley, they've cut a number of jobs, and they saw profits fall on the year in the third quarter, in part because of this prolonged slump. But and then optimism about that returning has started to dip, about the market bouncing back has started to dim lately because of the sort of geopolitical crises we are now witnessing.
Yeah, I mean, it's an incredible performance, up 28% over the year. Bloomberg's Sally Bakewell, thank you. And I would urge everybody to read the story, which is a great title. It's basically, it was a tough year for almost every bank not named JP Morgan. And I guess, Shonali, this is one of the reasons why Jamie Dimon isn't appointing a successor too, and has the street talking about this sort of nonstop. I mean, why would he?
If it were me, I would leave on a high note.
Well, yeah, but he thinks the high note's going to, hang around next year and the year after, and Fortress Diamond.
What's interesting too is the KBW Bank Index, talking about the smaller banks here. You have seen it rebound a little bit, but really it is far off from the highs that we have seen pre-banking crisis in March. And so you have to wonder, is there more pain ahead, or do we start to see some relief among the smaller firms?
You are hearing some of the guests start to say that they would nibble at financials now, but, can we trust our guests? I don't know. Still ahead, Gus Fauché, PNC Chief Economist. He'll be coming on to speak all things economy for our Bloomberg radio and television audiences. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Markets. I'm Bonnie Quinn along with Shonali Basak.
Bonnie, I want to talk through some cross-asset moves over here because we talk so much about equities and we are in the middle of the Santa Claus rally. But now that the market is closed, I want to talk a little about other things because into next year, it's fascinating. We watch that dollar move and it's on fragile footing here. So much of the cross-asset move is predicated on these rate cuts. But remember, these are relative rate cuts we have to think about here. I want to point out the yen, for example, that has advanced pretty drastically from its November low. But just yesterday, you had Jefferies, for example, putting out a warning saying that investors might be getting carried away and that it makes sense as long as the position stays on the hope of Fed rate cuts and a BOJ rate hiking cycle. It's certainly an asset to watch. Gold as well. People are using it for a lot of reasons. Some as a hedge, as we've heard from our last guest. Bitcoin, that rally is back in play at 2.5% nearly. However, even there, you have some questions about whether that Bitcoin spot ETF, excitement is really priced in and whether we can hold all of these levels headed in
and
to
what happens
2024.
Exactly. Yeah, that yen, I didn't fully realize 10 big figures of a difference between now and just a few weeks ago. 141.83, and of course April is when a real decision is expected for the BOJ. So yeah, these markets are definitely trying to anticipate something. Joining us now to take us through his outlook for the U.S. economy in 2024 is Gus Fauché, PNC chief economist. So Gus, let's start right there. Why not? I mean, is the U.S. central bank going to cut in the first quarter, maybe even, precipitating cuts from other banks?
I would be very surprised to see the Fed cut in the first quarter of 2024. They want to see that inflation is slowing significantly towards 2%. We've made a lot of progress there, but I think the Fed wants to make sure that inflation is consistently at 2%. So I would expect to see the first rate cuts around mid-2024. Obviously, that's been pushing, expectations for Fed rate cuts have been pushing long-term yields lower, but I don't think inflation is going to be at the point in early 2024 where the Fed feels comfortable cutting.
When you say cuts later in the year, then will that be, one at a time? And how many do you anticipate the economy being able to handle or needing?
I think the Fed is going to be cautious. We've been through an extended period of high inflation. They want to make sure that inflation pressures are contained. So I would expect that the Fed will be cutting maybe every other meeting or something like that by 25 basis points. So maybe 3 or 4 rate cuts in 2024. Obviously, if we see the economy is starting to deteriorate, the Fed does have the ability to cut rates more quickly. But I think given where the economy is and the fact that it's still solid, given the fact that inflation is slowing but has been above 2% for a period of years, I think the Fed is going to be cautious and does not want to cut rates too quickly over concerns that inflation could heat back up again.
Well, let's double down on that view because you have a market here that's essentially taking for granted that they're going to see a series of rate cuts next year. But a lot happens between now and then. What is the risk that inflation is a bigger problem than the market is now expecting?
We've been through a period of high inflation. Certainly the potential for a war in the Middle East could push inflation expectations higher. Perhaps housing costs don't slow as significantly as we're expecting, or the labor market remains strong and wage pressures remain strong. So there are lots of reasons to think why inflation won't slow as quickly as markets are expecting. Even if we get a small hiccup along the way, the Fed may say, hey, we're going to hold back for a little bit. The economy is doing well. There's no need to cut rates quickly. So I think given everything that we've been to, given that there are still some upside inflation risks out there, I think this view that the Fed is going to be cutting aggressively in 2024, I just don't see that.
So this idea of, for example, housing being a problem, or even oil being a problem, or even wage inflation is another thing a lot of our guests are talking about a lot more these days. What are the signals that you're looking for to show you that these will be a bigger problem potentially than meets the eye?
Well, there are lots of wage measures out there that we pay attention to. So average hourly earnings, the employment cost index, and so forth. The Fed is going to be looking at all of those. The Fed will be looking at what's going on with consumer spending. Does that remain strong, or is that positive but slowing? And that's that second point, positive but slowing consumer spending growth is better from an inflationary expectations point. What's going on with energy prices? Certainly the Fed is going to be watching very closely there. So it's going to be a combination of factors that the Fed is looking at that would lead the Fed to feel comfortable cutting rates sometime around the middle of next year.
We're not going to get much economic data now again until the new year, Gus. What will you be looking towards in order to tell us if we're still on that trajectory that we have been on, which is pretty moderate growth and, pretty moderate inflation at this point?
The key thing is what's going on with the labor market. So do we see that job growth is slowing to a more sustainable pace over the longer run? So at the beginning of 2023, the economy was adding about 300,000 jobs a month. Now we're adding about 200,000 jobs per month. I think over the long run, the economy can add about 150,000 jobs per month. So if we see that job growth is slowing to that more sustainable pace, that average hourly earnings growth is slowing from it's around 4% now to around 3.5%, 3.25%, then I think the Fed can say, look, the economy is evolving. It's returning back to where it was pre-pandemic in terms of inflationary pressures, and that would give the Fed room to cut rates sometime next year.
Gus, do you have your eye on the repo market at all? It's obviously sending signals from time to time about financial liquidity. What are your thoughts regarding what signals it's sending?
Obviously, we're in an interesting spot because the Fed is still reducing the size of its balance sheet, which is contractionary. And yet at the same time, there are expectations that we'll see Fed funds rate cuts, which are expansionary. So I think that the Fed is trying to suss out exactly what the size of its balance sheet should be. That we may see some modest dislocation in repo markets. But I would expect that as we get, over the next 3-4 months or so, the Fed will be sending indications of what it expects the size of its balance sheet to be over the longer run, and it will try to ensure that there's appropriate liquidity in financial markets.
Speaking of financial markets, we have to remember that even though that there's a relative calm now, and that the last several weeks have brought us a tremendous rally in the markets, we are near highs for the S&P 500. We have to remember the banking crisis of March. We have to remember that a lot of these companies are still very fragile. So if you think about next year in financial conditions, is there a risk that things are worse than they seem, that conditions can get tighter very quickly given the stresses that are still boiling under the system?
Certainly, and we saw that earlier this year, in the fall when we see long-term yields increase dramatically, and that did put pressure on some companies. The Fed will be very aware of that, but the problem is that there are stresses out there in the financial system, and we're not quite sure where they are. So, for example, in March, we did see problems at some of the banks, and I think that if we see rates move higher, long-term yields move higher in particular, that we could see some of those stresses show up in the financial system, and certainly that is something that the Fed has to be cognizant of. The problem is that it's, we don't recognize things until they actually happen. So there are lots of unknowns out there about potential fault lines in the financial system.
And it begs the question also, how much control does the Fed actually have at this point over the long end of the curve?
Certainly, and we've seen that, the big swings, the big dramatic swings that we've seen in recent months. Obviously, with the Fed reducing the size of its balance sheet, that adds some volatility there. So the Fed will do what it can to try to keep long-term rates under control, but the market has a mind of its own. Certainly, I think the market is pricing in a lot more rate cuts in 2024 than the Fed has indicated we could be seeing. And so that does raise the potential that the long end of the curve could get away from the Fed and that could cause some problems.
Gus, are you surprised that we're ending the year or close to ending the year with a 10-year yield at 3.7852%?
Certainly, I mean, I was surprised when we got up to, 5% on the 10-year note, and then we've seen it move below 4%. So there's a lot going on out there. I do think that perhaps the market is pricing in more Fed cuts in 2024 than we're likely to see. So I would not be surprised if we see long-term yields move up somewhat from where we are over the next couple of months until we get a better sense of what the Fed outlook for 2024 is going to be like, both in terms of the Fed funds rate, but also the size of the balance sheet.
The curve is so interesting because the 530 spread is positive by about 15, 16 basis points. The 210 spread still negative by 45 basis points. I mean, is that kind of inversion telling us anything right now, Gus, or anything that we sort of don't already know?
Obviously, we thought 6-9 months ago that the inverted yield curve was signaling a recession. That has not turned out to be the case. I just think that there are a lot of countervailing factors that are going on right now in financial markets. We've got quantitative tightening. We've got expectations for Fed rate cuts. We've had very high inflation that's slowing. So I think it's difficult to get a read on what's going on in the economy and what's going on in financial markets from the yield curve. That being said, I do think that we will see, rates over the longer run, kind of normalize to close to where they were pre-pandemic. But it's going to take some time, and we're not quite sure what the process is going to look like over the next 6-9 months or so.
Speaking of, we've been talking about the long end of the curve. We started to address that issue about repo markets, and it's something, I've been watching 2018, 2019, 2020. There were significant problems, Gus. And if you think about how much volatility has been rising for the first time now in 5 years, is there a worry here that the structural issues in the market, you think the financing issues of the United States, you think bank balance sheets shrinking into next year potentially, that this issue could get worse?
Absolutely. We're dealing with a lot of unknowns out there. So we're dealing with quantitative tightening on a scale we haven't seen before. We're dealing with inflation, the highest inflation that we've seen in 40 years, although it has slowed. We're dealing with very large federal government budget deficits. So you put all of those pieces together, and it's very possible that there's a misstep out there or that financial markets misread the data. And so certainly I am concerned about the potential for disruptions in financial markets. That being said, I think at this point, the Fed does have the ability to respond quickly if need be. We saw that happen in 2018, 2019, and I do think that the Fed has the tools if we start to recognize that there are problems out there in the financial system.
But Gus, is that a good thing? Some would just call that moral hazard.
I mean, that's a valid point, but the Fed's job is to focus on financial stability. The Fed has the tools out there, and I think that if the Fed feels the need to act to stabilize financial markets to meet the dual mandate of low inflation and maximum employment, that they should respond appropriately. And I do think that that's the role of the Fed. That's the role of a central bank to address those types of issues.
It's our thanks to Gus Fauché, the BNC chief economist. We thank you so much, not only for walking us here through the fundamentals of the economy, but also some structural risks that lie under the surface. And Vonnie, I find it fascinating. He was talking about the Fed's role here in financial stability. The Fed's initial role was not about financial stability per se.
I mean, it does have a dual mandate, but I mean, I think financial stability was pretty much the reason why it was kind of set up in the first place, though, right, Chanali?
Right, but dual mandate, right? You're thinking inflation here, you're thinking the job market, and now you have to worry about banks failing left and right.
Yeah, no, I definitely hear you. Well, Hopefully not anytime soon. And February 1st is the next FOMC meeting, but March 22nd is when traders are eyeing that first rate cut. Not all of them by any stretch of the imagination, but even a bank or two is calling for a cut on March 22nd. And then, of course, May 3rd and June 14th. So we have quite a big calendar to look forward to next
And you have
year.
to wonder how many of those rate cut expectations come from that expectation that the economy can land more difficultly than initially expected. It's just another survey out on the Bloomberg terminal today, just about this idea that the job market, many employers are looking at job cuts into next year, frankly, after what's already been a pretty tough year for job cuts.
Yeah, in the tech industry, in the finance industry, what was it, something like 60,000 plus bankers? Now, this was globally, I guess, but, all of the banks are sort of global and local at the same time, right? So we have seen massive cuts, but when you consider, we are...
job market. Fine.
Yeah, exactly. But we're also looking at, very small slices of industries, and, we will see that number take up, most likely, that unemployment rate.
Yeah, absolutely. The question is, how painful does it get from here? A little bit of pain certainly does allow for those rate cuts to happen. Now, coming up next, we're going to talk about that economy relative to politics. We're going to talk to Mohammed Yunus, editor-in-chief of Gallup, on where U.S. President Joe Biden stands heading into the election year. Complicated election year, primaries around the corner. This is Bloomberg Television and Radio. Stick with us for the final block of the day.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg Markets. I'm Shanali Basak alongside Bonnie Quinn. Now, Donald Trump will remain on the Michigan Republican primary ballot after a ruling today from the state Supreme Court. And the Iowa caucuses, the first nominating contest in the 2024 election cycle, it's just over 2 weeks away. Joining us now to look at the polling ahead of next year's general election is Mohammed Yunus, editor-in-chief of Gallup. How does the polling set up into those primaries?
Well, President Biden today sits at the lowest approval rating of any other modern president going into a re-election year. My colleague Megan Brennan recently did a phenomenal analysis taking our latest presidential approval number, which was essentially running through the month of December, and he sits today at 39% overall approval. It's a 2-point increase from the month before. But listen to the other presidents who were up against this contest, particularly at this time of their presidency. President Trump, 45%. President Obama, 43, all the way down to George H.W. Bush at 51%, President Reagan and Carter at 54. So President Biden goes into this election year with a very challenged approval rating if history is to prove, prescient to the future. Of course, you mentioned, Sonali, that this is a very unique election year. There's a lot of kind of third variable factors. So the historic trend should really be studied closely, but also keep in mind that we are in a hyper-partisan environment. It shows in our data that dates back through every modern president, basically, that presidents tend to have lower approval ratings, and you see it in that list for the most part, with the exception of George W. Bush on the heels of 9/11. And that's only continued to worsen in President Biden's time.
What are you watching most walking into the Republican primaries in particular? What are the trends?
Well, I mean, one of the things that will really come up a lot, and we did a 30-year analysis on the issues that really drive the partisan wedge the most here in America. And what we found is essentially things around the size of government or the power of big government. And I mention that because with President Trump's legal challenges, that's going to be a very powerful message that he's likely to drive throughout the election campaign as we get closer to the contest. It's important to note also that attitudes around the economy tend to be the most important topic for any voter going into any election in modern times, whether they are a Democrat or a Republican. So how the economy is doing, in your previous segment about really the true state of the economy, are going to be really critical when it comes to November. Obviously, that's light years away in terms of how we think the economy will be doing. Right now, we see a relative improvement in our economic confidence index at Gallup, where we essentially assess people's sentiment about the economy now and where they see it going in the future. But it's still far in the negative, and Republicans will definitely be driving that topic home. The other really important topic for Republicans will be immigration. One of the most important questions we ask monthly is, what is the most important problem facing the country today? And immigration is relatively high for Republicans. It usually is already, but over a third of Republicans say that immigration is the #1 problem facing the country, and you're going to see that topic brought up time and again, particularly with the fact pattern at the border, which is really exceptional based just on headlines from this morning and previous couple days.
So, Mohammed, the Michigan Supreme Court leaving intact that ruling which allows Donald Trump to stay on the Republican nominee ballot. This after Colorado booted him. How does this progress? And we should all bear in mind that none of this is any reflection on whether or not Donald Trump can be on the general election ballot.
Well, from our perspective at Gallup, we're really focused on public opinion and not so much on the federal court system or legal battles from state to court. It's essentially going to be about when people start tuning in. Right now, most Americans are actually not paying that much attention, frankly, to the election. They're certainly not paying as much attention as we are to it collectively here in this conversation. But as the year progresses, and as you mentioned, that's one of the huge kind of third variables in this scenario. As these cases unfold differently for every state, it'll be really interesting to see how much it impacts
right. And so are you
message.
polling in these states in order to get an early glimpse as to what it might mean for the voters there if they're turned off, if they're in agreement with their state Supreme Court or their state High Court or what have you? Have we any data on that yet?
Yeah, well, at Gallup, we don't do state polls. We do the national picture. And one of the things that has really come through in all of that national polling, and we have done quite a bit of it ever since the very beginning of these legal issues, is that for the most part, people who support President Trump don't really it doesn't really impact their perception of him. In fact, the more these cases have come to the forefront, it seems to very clearly, both in our polls and others, and I think this is a pretty established theory now, it's only solidifying his support with his base. So the notion that any one state government court decision is going to sort of throw off the election or throw off a primary for him is not necessarily something that's rooted in the data. I know that's a very exciting thing to kind of consider happening. But based on the data, what we find is that essentially people that support President Trump are going to continue to do so throughout the whole myriad of legal challenges he now faces.
So then we have Joe Lieberman and the known labels, Unity potential nominee or not nominee, but at least, entrant into the race. Have you done any polling on whether that will actually impact things?
Well, it's really interesting that you bring that up because one of the really interesting trends right now is the relative high rate of people who identify as independents. Right now, today, about a third of Americans, 42% of Americans identify as independents. That rate is actually held pretty steady since a high that we at first captured in 2008, 2009. So as Lieberman, Kennedy, all of these other leaders step to the fore and really try to present an alternative approach that goes kind of beyond the bipartisan paradigm, it will be interesting to see if they can garner that support. Now, that being said, it's important to keep in mind, first of all, that national politics and national parties tend to not be very popular when it comes to public opinion. So when we ask people, do you identify as one group or the other, you're really getting down to the core. And right now, there are more people identifying as independents than Democrats or Republicans. The other factor with that is to keep in mind that just because people identify as independents, it doesn't mean they necessarily all agree on a particular ideology or a set of policies. A lot of times it essentially is somebody that's refusing to pick a side because they're turned off by both, or people who tend to lean in one direction or another on one topic or the other.
Mohammed,
so even though there's a relative high, it doesn't mean these folks are going to be
When we think
victorious.
about the field that is building into next year also, we've broken a lot of news on this program about a large Republican donor starting a rally behind Nikki Haley. At what point and what would it take for really more polling to fall into her favor?
Well, I mean, I think it's very early. Obviously, Nikki Haley is a very competent and effective national figure at this point. It'll be interesting to see how things unfold. We are not polling necessarily on her in depth right now. Her challenge, like all others stepping in before a former president and an incumbent president, is that name recognition is going to be a challenge. Now, as the public begins to focus on the election, and we're going to see that halfway through the year, it'll be telling whether Nikki Haley can really garner the name recognition that would even give someone who is stepping into an arena with two former presidents, current presidents, a chance to even be known and heard. We've seen many of the other names that have entered the race haven't really garnered any kind of significant or unique early name recognition factor, whether it's Governor DeSantis or others. So that's always the question with somebody stepping into a contest between very established, recognized names like Trump and Biden. Halfway through the year, could things change? Absolutely. But right now, we don't see that either in our polls or really in others.
All right, Mohammed, we have to leave it there. Thank you. I do want to mention, though, that you also have new data out on Israel, and 1 in 4 Israeli adults currently supporting the existence of an independent Palestinian state. So Israelis no longer supporting a two-state solution, I think, is your finding. Our thanks to Gallup Editor-in-Chief Mohammed Yunus. And Shonali, I think it's fair to say that we had another day where the market sort of teetered and it's just inching ever closer. And I thought that was a very trenchant point that was made earlier that, for tax purposes, people don't want this market to go anywhere, at least until the 1st of January. And that's why the Santa Claus rally goes to the 2nd.
Yeah, absolutely. Poignant point. And it begs the question, what happens when we turn the year? And by the way, you want to make a bet at this point? Are we going to hit this record or not? Is it Thursday? Is it Friday?
Oh, well, it
over,
depends.
under?
What do you want to lay down, Shonali? Because I only do the big bets.
I take Friday. I will lay you down.
No, I'm talking about the actual. What are you putting at stake?
Oh, I was just going to buy you Starbucks.
Oh, okay. Well, I might just sit this one out then.
Okay, I'll come back tomorrow with a better prize.
No, I think, of course, we're going to make the record. Don't you?
I do. Is it whether it's tomorrow or whether it's Friday? Do we face a pullback? No one wants to sell.
We'll be back at least.
We will. That does it for us here. This is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization. and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
This is Bloomberg.
Josh, that's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
It's 6 a.m. in Hong Kong, 9 a.m. here in Sydney. I'm Paul Allen with the top stories this hour. Apple has won a court ruling to temporarily pause the U.S. ban on sales of its latest smartwatches. The U.S. International Trade Commission had blocked the import and sales of the products over patent infringements. The commission has until